All three, right? All three are important. If you change any one of those three variables, those three parts, does that change the money machine? Sure does. If you change the income, that completely changes it. If you change the expenses, that completely changes the return. If you change the financing, it completely changes. Once you know the three parts of the money machine, then you can flip the on switch and it produces 4 financial benefits. What are they? Go ahead and write them in your notes, page 3. Just go ahead and humor me with this. It'll do it without, I'm not going to tell you the answer. What are the 4 parts, 3 parts of the money machine? Income, expenses, and financing. What are the 4 benefits, the 4 financial benefits? I'm gonna turn off the video just because that's distracting. Okay, you tell me, what are the 4 financial benefits? This ought to be second nature to you now. Income, which is cash flow, principal reduction. Yeah, good, Sarah, you're cooking. Tax savings, right? Yeah, and appreciation, capital appreciation. Tax savings. Let's talk a little about tax savings. What creates the tax savings? Depreciation, right? Depreciation, which is what kind of expense? Non-cash. Non-cash. Tax deductions are good, yes? Non-cash deductions are great because you get to deduct them, you just don't have to pay them. Right? That's my kind of deduction. And then we talked yesterday about what happens when you sell and how to reduce the recapture. Remember the depreciation coming back, because you will be a bifurcating specialist when you sell. If any of you are thinking of selling a rental property, absolutely talk with your good tax manager about reducing or in fact eliminating recapture by bifurcating the agreement when you sell. Remember, you as a seller want to get the most of your gain, as much as possible, on the what? On the land. You want to get it off the depreciable assets and onto the land. And you think, well, how can I do that? And isn't that logical? If you think about it, what if you bought a property that had $20,000 of personal property in it, and 7 years later you sold it? Well, that personal property didn't go up in value, it went down in value. So it's totally legitimate to revalue the depreciable assets when you sell, as a bifurcating specialist. All right, so tax savings. What creates the tax savings? Depreciation. And we want to bifurcate into what? Land, building, personal property, and land improvements. You see under where it says depreciation rules? Why do we want to do that? Because each of those 4 categories is depreciated over a different number of years. How many years? You tell me. Next to each one, I want you to write the answer. Next to land, personal property, residential rental building, non-residential, and land improvements. Tell me how many years. Write it down. If everybody gets the right answer, we'll move on. If anybody misses, we're still going to move on. So there's no pressure. Again, this should be just, I want this to come to you easily. Yeah, Stacy, there you go. Land is nothing, right? You can't depreciate the land. What about the personal property? Yep, personal property, 5 years. Good. That's it. Alicia, good. You got it. You're all doing great. Yeah, land improvements. Good. Are you doing it without your notes? Try doing it without your notes. I want to just to quiz yourself, to test yourself. So you're getting what I'm getting up there, right on the screen. The land, you cannot depreciate the land. Personal property, 5 years. What if it's a really old refrigerator? How many years? 5 years. What if it's brand new refrigerator? 5 years. 5 years. All right. The building, if it's a residential rental building, 27.5 years. If it's a non-residential building, 39 years. What if I have what if I don't have a mortgage? How many years on the building? 27.5 or 39. What if I have a giant mortgage? 27.5 or 39. The depreciation has nothing to do with your mortgage. Has nothing to do with your age. What if I'm 18 years old? 27.5 years. What if I'm 98 years old? 27.5 years on a residential rental building. What's the definition of a residential rental building? Anything that people what? Live in for at least what? The minimum tenancy is what? Month to month tenancy or greater. So anything less than month-to-month tenancy is a non-residential rental building. So typically, you asking yesterday about Airbnb or some of those issues where people rent by the week, typically that would be a non-residential rental building. Non-residential. Personal residence, no. Steve, good question. Does your primary residence depreciate? In tax-wise depreciate, not wearing out. This has nothing to do with wearing out. But no, this is for investment property. Now, a home office, you can take depreciation on a home office, and that would be non-residential, 39 years. Okay. How about what if you owned a duplex and lived in half? Then the half you rent out is depreciated. The other half is treated as your primary residence, where you have those rules where if you sell it and you've owned it 2 of the past 5 years, you've got some gain. Commercial properties, Brenda, what about commercial properties? That's a non-residential building, right? People don't live there. So a little shopping mall, that's non-residential. A store, what if you own a store and downstairs? Upstairs and downstairs. That's a non-residential. What if you live in a house and then move out? What if I've lived in my house for the last 5 years? It's a great house. I really like it. And then I get transferred, but I'm not going to sell. I'm going to rent it. Do people do that? Can you start depreciating it when you rent it? Yes, you start depreciating it when you rent it. What if I had a house? What if I have a house right now that I bought years ago for $100,000 and today it's worth $150,000? I get transferred and I move out and I rent it. Can I start depreciating? Yes. What's my depreciation based on? My cost is how much? Not $150,000 that it's worth today, but what my cost is $100,000 years ago. So it's the $100,000 that I divide into land, building, personal property, and land improvement. Well, how about a commercial property that you live in and the other part's a store? It's the same, just like a duplex, Brenda, would be you live in part, the part you live in, you base it by square footage, that's treated as your primary residence, and the part you rent out, you depreciate. So if it was 50-50, then 50% of the cost you would divide into land, building, personal property, and land improvement. So all those are possible. So that's great. And then land improvements. We put a little star by land improvements. People, I'll bet you a nickel, you're not depreciating your land improvements. And if you are, you have a superstar account, and that's great. That's terrific. But what are land improvements? Improvements to the land that don't need no stinking building to do what they do. And so it would be like what? Think of improvements you make to your property that don't need the building. And the easiest way to think is something a land improvement is picture your property and mentally take away the building. If the thing that you're thinking about could do its job without the building, it's a land improvement. If it needs the building to do its job, then it's part of the building. So mentally take away the building. So what's left? All the landscaping is a land improvement. The driveway, sidewalk, parking lot, fence, underground sprinkling system, swimming pool, tennis court, playground, golf course, all those things are land improvements. You've got a lot of land improvements. If you own a rental house, you've got a lot of land improvements. If you own a rental condo, what do you own? I just got a phone call yesterday over the lunch hour from a person in Florida who has a rental condo, and she said that her accountant just did land and building. Well, it was a furnished rental condo that she's renting out, furnished. Well, think all the furniture. She probably had $75,000 of furniture in there. And the land improvements, she owns unit number 94, plus she owns X percent of the common area. Well, virtually the entire common area is a land improvement. So she has a share of the parking lot, the driveway, the landscaping, all that stuff. Okay. Stacy, I got to read here. Yeah, if you replace you get to recover your cost, right? So if you incur additional cost, you get to recover that cost. So you could have 2 schedules going. Could one part be in its 3rd year, and then you put in something brand new today, it's in its 1st year. And so you got a couple schedules going. Let's try the bifurcating specialist. Remember, you are a bifurcating specialist. I would say you are right now junior bifurcating specialist. Let's see if we can get your senior bifurcating specialist degree. Look on page 3 now. You know that you divide the personal property is 5 years, the building is 27 after 39, and the land improvements are 15. It would make sense if you could just divide the personal property by 5 to get 1/5 every year, divide the building by 27 and a half, get 1/27 and a half every year, divide the land improvements by 15, get 1/15 every year. Wouldn't that make sense? Wouldn't it be logical? Wouldn't it be easy? Yes, yes, yes. Therefore, what do you know? No, you can't do it. You can't do it. The IRS gives us percentages that we must use. And those percentages are, I've got the first 2 years down at the bottom of your page 3. And so look, on the personal property, you get 20% the first year. On the land, then the second year, you get 32%. And then there's each of those: land, building, personal property, and land improvements. And then we did an example yesterday of the tax savings if you bifurcate versus if you do not bifurcate. And so I want to start with another little case study. That's what the phone call I got last night was, from one of you. And that's great. I'm glad you're interested. You're not bothering me a bit. And so what I want to do is start out the day with a little case study. Turn in your book now to page 11. Page 11. And we're going to do it like we did yesterday, only with different numbers. Page 11, look at practice case study, the practice case study on page 11. Okay, you with me? All right, let's read it. You're in the process of purchasing a small apartment building. Underline apartment building, and why is that important? Is it residential or non-residential? Residential, right? The biggest apartment building in all of Nebraska would be a residential rental building, as long as the leases were what? Month to month or greater, or the tenancy was month to month or greater. So it has a cost of $1.4 million. Your accountant has advised you to use the assessor's land building ratio of 20% for land and 80% for building. Now, I'm saying 20/80. It's not always 20/80. The way to do this is look at your tax statement and look at what the assessed value is. And doesn't your assessed value say this much is land and this much is improvement or building? They might call it improvement. Figure out what percentage the assessor is saying is land, and then apply that percentage back to your cost. That's the way to do it. In this case, though, your accountant is just saying, all right, we're going to divide it into land and building. Now, you right away, right, as a junior bifurcating specialist, you know that ought to make you nervous. But let's do it anyway. Calculate your depreciation for the first 2 years. All right, so let's do this. I'll do the numbers for you on this one. So I go to my accountant and I say, hey, I bought a property for $1.4 million, an apartment building. Oh, great. And can I depreciate this? Yes. How do I do it? Well, you divide into land and building. That's what I would say 90% of accountants say. All right. In this case, 20% is land and $280,000, and the remaining 80% is building, $1,120,000. All right, let's figure the depreciation for the first 2 years. And I'm using 2 years just as an example. We could do this for 3 years or 5 years, but I just want to make the point. On the land, we get nothing every year. You can't depreciate the land, so that's easy. All right, on the building, it's a residential rental building, and you look at the chart, it says in the first year, you get 3.48%. 3.48% of $1,120,000 is $38,976. The second year, I get 3.64%, which is $40,768. You add that up, that's $79,744 in total depreciation in the 2 years. So owning this property gives me $79,744 in depreciation. Every dollar of depreciation will shelter $1 of my income. If I'm in a 35, what are we doing here? 35% tax bracket, state and federal, 35% of that would be $27,910 income tax saved. $27,910. All right. So I think this is fantastic. My accountant's a genius. Well, but you as a bifurcating specialist, junior, you realize, no, that's not genius. That's not genius, because you know better than that. Before the closing, look at paragraph 3. You attend a seminar taught by some guy who talked about bifurcating. He really got your attention when he showed you how to appreciate personal property and land improvements. Recalculate your small depreciation on your small apartment building by assuming the personal property and the land improvements are each 10% of your $1.4 million. How much extra depreciation does this method provide? How much extra tax do you save? And then I'm going to add one. How long will it take you to get a new accountant? So now here's the thing I want you to remember in the little aha. Let's say that the assessor's ratio is still 20/80. So the assessor is saying 20% of the assessed value is land. So in this case, as a bifurcating specialist, how much land do you have? And you think most people would say, well, 1,000,004 times 20% is 280,000. No, that's wrong. That's wrong. Because your assessor's land building ratio is exactly that. It's a land building ratio. It's not a land building personal property and land improvement ratio. So before you apply the assessored land building ratio, be sure to get the personal property and the land improvements out of there first, because they have nothing to do with your assessor. So in this case, what we're saying is the personal property is 10% of the 1,000,004. So we have 140,000 personal property and we have $140,000 land improvements. Get those out of there because they have nothing to do with the assessor's land building ratio. And so what's left then is 1,120,000. And the 1,120,000, that's the land and building. So the land is 20% of, not 1,000,004, 20% of 1,120,000, which is 224,000. And the building is 80% of the 1,120,000. Okay, you with me? Get the personal property and the land improvements out of there first. Otherwise, you're going to overvalue the land. You don't want to do that because the land is not depreciable. Now, here's what I'd like you to do. Look at the percentages back there on your page 3, and you tell me how much depreciation I get in year 1, year 2. Give me the total, multiply by my tax bracket, and tell me how much extra tax you save over and above the way your accountant did it as a bifurcating specialist. All right, go ahead and do it. You can do it. Chat in your answers now as you go. You're going to figure the depreciation for year 1 and year 2. Give me the total all the way down, multiply by my 35% tax bracket. And tell me the difference between the way your accountant did it and the way you're going to do it from now on. This is really important. It's really important. It's one of those things where if you show this to a client, it's an aha. They're going to say, no, nobody's ever showed me this before. You'll have a client for life. All right, go ahead and do it. I'm going to be quiet. Chat in your answer as you go, please. Could this be absolute real world? Yes, 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 yes. Some of you own this property. And because it's 1,000,004, the same thing would be true if it was a $140,000 rental house. Same difference. All right. Chat in your answer when you get the total depreciation of each one. What's the total personal property? What's the total land improvements? What's the total building? Yeah, Sarah, that's perfect. That's your personal property. Do the 2 years. We're comparing the 2-year total to the 2-year total. April, good. That's very good. Just round off to nearest dollar, everybody. Don't put any pennies into this now. Use the percentages back there on page 3. Those are not my percentages. Those are IRS numbers, not my numbers. That's good, Sarah. That's your land improvements. That's it, Steve. And then multiply that, Steve, multiply your total by the what do we got? 35% tax bracket. Brenda, that's it for personal. Good, very good. Take your time now and think how you would explain it and think how you would use it. Yeah, Steve. So that's your tax saved, Steve, right? So compare that, look at it to the way your accountant wanted to do it. It's twice as much. Daniel, I think there's I'm not sure that's a big number. 280 million. I think Is there a comma in there somewhere? I'm not sure. Daniel, take a look at, yeah, 72.8, good, good. Yes, Steve, good. Good. Do you think you're just doing land and building, Steve? Which would be very common, you know, that I wouldn't be too hard on the accountant, but I'd certainly ask, hey, why aren't we doing this? Yeah, Stacy, look at that. It's twice as much, isn't it? Jane, now multiply that number. That's your total depreciation, or that's your total tax savings. Take the difference between that, the way you, a bifurcating specialist, are going to do it, and the way your accountant's doing it. Yeah, Mike, that's it. Yeah, Jane, that's it. Look at that. That's twice as much. That's just in 2 years. Take your time, take a peek at the screen now as you finish up. I've got the answers on the screen. Now don't just copy them. That's not fair. But double check. And if you're not sure where number comes from, now you tell me. So Mike's question, you know, it's real important to have accurate numbers here. So the question is, how do you document this? The best way is put it in the purchase contract. But if that's fine if you're dealing investor to investor. But if you've got a client who's buying somebody's house if they're buying my primary residence and they're going to use it as a rental house, I don't put this in the agreement. You're going to just scare people, and the lender's not going to understand what you're doing. So typically, as a buyer, you want to, when you're doing your taxes, you want to estimate, and you could estimate how much personal property you got and how much land improvements. So there's no here's exactly the number, but you don't want to be a pig about it, but you want to be aggressive. Yes, Sarah, remind me, I'll do that. Yeah, MACR, that's right, Mike. Yeah. What are land improvements? Land are improvements to the land that don't need the building to do what they do. They're improvements to land that don't need the building. So think about this. You own a rental house. Take away the building mentally. All right, what improvements are still there that don't need the building to do what they do? How about the sidewalk, the driveway, the parking lot, if it was an apartment building? How about the fence? How about all the landscaping, the underground sprinkling system, the swimming pool? None of that needs the building, so they're land improvements. If they need the building to do what they do, then they're part of the building. How about the utilities? Are those land improvements? No, because they service the building. Without the building, the utilities would have nothing to util. If you've got an unfinished apartment building, sure. Is there still personal property? There could be stove, refrigerator, washer, dryer, drapes, curtains, carpeting, garbage cans. Yeah, a detached garage would be a building. A garage or a barn would be a building, right? How about, do you know what I mean if I say a carport? A carport, do you have carports in Nebraska? In Arizona, in Scottsdale, we have carports. I own some condos that, or I did, I don't own them anymore. Some condos that had carports. Those carports are land improvements. They're not buildings. They don't need no, and they don't need no stinking building to be a carport. No, Daniel, you start with your cost. What's your cost of the land improvements? And then you depreciate those over the 15 years. Now, I'm just showing you the percentages for the first 2 years. If you want the percentages for all the years, again, go to my website, click on the baseball bat, and that'll take you to all the years. Yes, Stacy, exactly right. I didn't sell, I exchanged. What numbers now for clients? The percentages for depreciation, you got them in your book there for the first 2 years. Look at this. So let's do it. Did y'all get the right answer? You work through and by bifurcating land building, personal property, and land improvements, you did all the math. You got 156,000 in depreciation rather than 79,000, the way your accountant did it. So I can now earn 156,000 in the 2 years without paying tax. 35% of that is 54,913. So you do it the way your accountant did it, you save 27,000. You do it the way you're going to do it, you save 54,000. The difference is $27,000. That's just in 2 years. That's a big deal. That's a real big deal. And it could be a bigger deal if it was a $5 million property, and it could be a smaller deal if it was a $50,000 rental condo. But the concept is exactly the same. Now, sometimes in a large property, you can get what's called a CSA, cost segregation analysis, or CSS, cost segregation study. There are companies that provide cost segregation studies. And what all that is they come in and they bifurcate for you. You were asking earlier, I think what Mike was asking, how do you justify this? Well, there are companies that will go in and give you a written report of how much of your property is land, how much is building, how much is personal, how much is land improvements. But those are generally quite costly, and so they're done for large properties. But there's nothing in the rules that say you have to do that. You just have to be reasonable here. Okay, yeah, I heard about parking lot. Yeah, look at that. Look at Steve, look at that improvement. Parking lot is a land improvement. So you don't, now again, remember the study, or the what do you call it? Remember yesterday we talked about, we're not trying to turn ourselves into an accountant. The disclaimer, Steve, you don't want to be the guy's tax person, but the way to say this to somebody is, now you're putting in a new parking lot, how are you going to depreciate that? They go, well, I don't know. Then you want to make, a real good thing is for you to go with them to their accountant. You go with them and then walk in and say, I know you know all this stuff, but I went to this seminar and they talked about this. Is this right? And let them talk, let the accountant be the hero. But I'll tell you, you'll get really good referrals from accountants and attorneys once they realize that you understand this stuff. Now, how about this? The difference between the two, which of these two methods is legal? They're both legal. They're both legal. If you're doing it land and building, the IRS isn't going to call you up and say, hey, I think you could do better. No. It's your money. You're the one who cares about your money. Now, what if I didn't realize this? I've owned this property for years, and now I realize I've been doing land and building, and I realize I could and probably should have been doing land building and personal property and land improvement. Can I just switch overnight? No. This is just for investment properties now. Okay, Sean, what's your first name really? It's just for what's your first name? It's just for investment property. Your primary residence, no, doesn't count. Remember, that's a different thing. That has different rules. But now, what if I realize this now, and I think I just been doing land and building? That's a big mistake. Can I just switch? You cannot just switch. You have to go back to the beginning and start over. Yeah, Eric, your primary residence has totally different rules. Don't confuse the two. Remember we said yesterday, all dollars are not created equal. There are different tax rules for money you earn from your job. There are different tax rules for money you earn from your primary residence, and there are different tax rules for investment property. We're dealing strictly with investment property. All right, but now remember I said, if you want to correct this, you could just amend your tax return here to go back to the beginning and say, okay, I didn't mean land and building, I meant land building, personal property, and land improvement. And you would amend your tax returns for year 1 and year 2, and they'll send you a $27,000 check. This example. But the problem is you can only amend a tax return how far back? 3 years. So if you realize this in the first 3 years, okay, all right, good. But the problem is, what if you've owned this property for 5 years or 8 years? And this yesterday, remember I said, repeat after me. You think you are dead meat, but you are not dead meat. Not dead meat. And the reason is, Form 3115. Remember that? We talked about that a little bit. Form 3115. Here, I'll put one up on the screen. Form 3115 is an IRS form. Ask your good tax manager. All of this, you want to deal with a good tax manager. But you go in and interview those people and ask them how they treat depreciation and so on. And you'll get a sense of, is that person up to speed on how this all works. But Form 3115 is an application for a change in accounting method. And it's a few pages. And one of the sections is depreciation. And in the depreciation section, it says, all right, how have you been depreciating? Well, I did land and building. How would you like to depreciate? Well, I want to do land building, personal property, and land improvement. And so you fill this all in and you say, I've lost this much depreciation. Can I have it all now? They'll say, yep, take it all now. And then you switched from land and building to land building, personal property, and land improvement. And you carry forward. Okay, Form 3115. Be sure to ask your accountant, have they ever filed a Form 3115? If they don't know what you're talking about, well, they haven't. All right. All right, very good, very good. You're doing well. Now you're all warmed up, aren't you? So let's make sure that our old friend, the investment property worksheet. Remember that now? This investment property worksheet. You're going to use this worksheet in your life. I guarantee it. I promise you. For those of you who work with investors or who are one, this is the absolute backbone of your investment practice. And you can analyze a rental house or a big shopping mall. Now, people often ask me, hey, do I have this on a spreadsheet? And the answer is no, I honestly don't. And maybe I'm just old fashioned, or maybe I'm just old, but here's why. I think that from a sales standpoint, there's a million softwares that analyze investment property. I've never seen one that does land improvements, by the way. But and the problem is, if you print it out and you take it to your client and say, hey, look at this, you ought to buy this. And the client says, well, where'd you get this number? And you go, I don't know, the computer got it. I think you're going to be so effective walking somebody through the worksheet. And you even do it like, I know you already know this, Mr. Client or Miss Client, but let's just make sure we're talking the same language, and then walk them through the worksheet. And what you're doing is you're selling property, yes, but you're really selling what? You're selling yourself. You're selling yourself. They're going to say, hey, man, this realtor really knows what she's doing here. I've never talked with anybody who understood this. And so walk people through. And I would really recommend to you that get so you can do this backwards, forwards, upside down, and then use a generic example in your from your market. Say, if I was your client, you'd say, Tom, I know you're interested in investment property. Come on into my office, though. Let's just have a conversation first before we start looking at property. I want to walk down through an example, and you use a realistic example that you use every time. And so you have those numbers memorized, and they're easy for you to think of. And you walk somebody through, Tom, here's how this works. Cash flow, principal, and tax savings, and these dollars are better than those dollars in depreciation. And you get down to the end, you say, would you be interested in something like this? Yeah, are you kidding? All right, now let's go look at some property. An hour or two spent in your office will save you tens of hours out in the marketplace, once you have a target you're looking for. So I want to do an example of the case, of the worksheet. And so I really want you to have this nailed down in your own mind. So in the back, take out a blank worksheet. Just take out an investment property worksheet, tear it out of your book so you don't have to flip flop back and forth. All right, and then please turn to page 4. Please turn to page 4. And at the top of page 4, it says case study number 1. So I'm in section 3, the valuation, how to value rent the property portion of your big long 60-page handout. And look at page 4 and put case study number 1. And let's read this. I'm going to give you a second for everybody to get there. If you can do this case study, which you're all going to be able to do, you really know your stuff. There's not 1 out of 100 people with a real estate license who can do what you're doing right now, and every one of you is going to be able to do. I want to prove to you how much you've learned. All right, you're considering the purchase of an apartment building in your town. Please calculate the first year benefits and the rate of return. And this case study is so good. The first two sentences, I repeated them. Just the first time I noticed this. That's my mistake. All right, the purchase cost is $904,000. So at the top, put $904,000. Now, what if I called you up and said, hey, what's the price on that property you got listed? What are you going to say? I don't know and I don't care. It doesn't give you the price. It gives you the purchase cost. What's the cost include? That's the price and the out-of-pocket and the closing cost. The cost, the total cost. The cash invested, $253,000. That includes the down payment and the out-of-pocket closing costs. We're going to get a loan of $651 at 5% interest, $4,200 a month. $4,200 a month times 12 is $50,400. Right, you with me? So what if I say you ought to buy this thing? You say, well, come on, I need to know the income. Well, look at the annual rent is $119,700, but we're not going to collect all that. We're going to have a vacancy of 8%. So it's 8% away, and you're left with $110,124. Then out of that, we've got to pay our operating expenses, and the total operating expenses on this property, $49,556. 49. Now, what if I just said, trust me, just trust me, these numbers are right. Are you going to trust me? No, you're not going to trust me. You're going to make an offer based on these numbers, but you're going to make it contingent on seeing my Schedule E. Schedule E. If I won't show you the Schedule E, be nervous. Be nervous. There's no reason an honest seller wouldn't show you the Schedule E. If you're listing this property, you want the Schedule E up front. And you don't make a big deal of it. Just as you're talking with the seller, say, now, of course, I'm going to need to verify. The buyer's going to need to verify. The bank's going to demand the Schedule E. So I need your Schedule E right up front. All right. And so here's my question to you. Would you take a moment and take some time and see if, you know what? I'm looking at our time. It's 9:50. Let's take a break. Let's take a break. Let's take a 10-minute break. Get up and walk around. Don't work ahead of me now because I'm going to change something. Get up and walk around 10 minutes, and then we'll come back and really nail this thing. All right. Just I don't want to have to break in the middle of it. So just put your pencil down, lean back in your chair, think how smart you are, and take a break. Go get a cup of coffee. If you have questions, chat them in to me, and I'll see you in 10 minutes. How's that? 2-minute warning, everybody. 2 minutes. We'll go to work. Let's go back to work, everybody. Let's go back to work. So I'm going to put you to work. So here's what I'd like you to do. Take the worksheet. I'm your client. I'm your client. I'm thinking of buying this apartment building, $904,000. The cash invested, $253,000. I've got that. Let's say I'm going to borrow $651,000. So we know the gross operating income after vacancy is $110,124. And my total operating expenses are $49,556. And let's say we verified that using Schedule E. Remember what Schedule E looks like? Here, I'm going to put one up again, because Schedule E, it's nothing scary, and it's something we all should be familiar with. Here's a Schedule E, and you can have up to 3 properties on one Schedule E. Here's column A, column B, column C. Those are 3 different properties. And here's a list of, here's the rents received. See this? And rents received, and then here are your expenses, all your expenses, including your depreciation. So that'll be right on there. And then here's your taxable income down here. And so there's absolutely no reason that you should not have Schedule E if you have a rental property listed for sale. And if you're buying a rental property, then for sure you want to make it contingent on seeing the seller's Schedule E. If they won't give it to you, then something's wrong. Something's wrong. Remember the story I told you yesterday about the lady in St. Louis, Missouri, and the listing broker was marketing the property with 93,000 something gross operating income, and she got the Schedule E, and it was really 38,000. Well, that's not going to work. And the worksheet would say, if you ran it at 38,000, that's not going to work. So real important to have that Schedule E, real important to have accurate numbers. This worksheet is great. You're going to know and love this worksheet. And if you build it on a spreadsheet, same thing. You're going to know and love how it's laid out, but it's garbage in, garbage out. You don't want to put garbage in there. So here's what I want you to do. Take your time and see if you can complete the worksheet for me. Tell me my rate of return if I buy this property. And so you got to figure the cash flow. I'm giving you the interest. I'll always give you the interest, but you've got to figure the depreciation using the percentages. And I want, this would be like a real example from the real marketplace. See if you can give me my cash flow, my principal reduction, my tax saved. Let's say no appreciation, 0 appreciation. And what's my rate of return if I buy this property? Then if you finish before everybody else, try it for cash. Try another one for cash. And this is where I say there are not many people in the real estate business who can do what you're doing. Think of this, I'll prove it to you. Mentally, picture the people in your real estate office. How many of them do you think know this? I would bet not many, and even the people who've been in the business a long time, because this is a separate part of the business. This is a separate part of the business. We don't automatically learn this stuff. All right, go ahead and do it. Please, please, please chat in your answers as you go. What's the cash flow? What's the principal? Just like we've been doing. That really, really helps me. All right, no pennies, round off to the nearest dollar, and see if you can give me my rate of return, and I'll bet you can do it. And then what I want you to be thinking about, is this property worth $904,000? Yes or no? If it's not, how much is it worth? Okay, go ahead and do it. I'll be quiet. Chat in your answers, please. I'm going to give you about take your time. I'm going to give you enough. That's it, Daniel. April, that's it. Stacy, we're on page 4, case study number 1. That's it, Eric. That's it. Well done. Now, when you get your cash flow, chat it into me, but you tell me why those cash flow dollars are better than dollars from your job. How would you explain that to me? April, that's it. That's your principal reduction, right? The interest is given in the problem, everybody. Eric, that's it. April, good. Now, what do you tell the IRS? Pardon me. That's it, Daniel. Brenda, that's it. Well done, well done. Tell me about the principal reduction. When is that taxed? Sarah, what'd you get for depreciation? Sarah? Yeah, good. Well done, Sarah. That's great. That's great. So now, Sarah, try it for cash. You've got to do the depreciation now, everybody. You've got to calculate that. Remember up at the top, up toward the top, it says, what's the land value, personal property, building and land improvements? I'm giving you that, but you've got to apply the appropriate percentages. Where in the past, I've given you the total depreciation. Well, that's not going to happen in the real world. So I want you to be able to do it on your own. Sarah got it, nailed it. That's great, Sarah. Don't let the numbers get you down. Let your calculator do the numbers and you think how you would explain it to people. Daniel, what part? What part now? Confused. I want to help, but I'm not sure. The depreciation, remember, Daniel, look at the screen. Can you see my cursor? The depreciation you're going to do up here. Here's the land value, personal property, building, and land improvement right up here. And you're going to multiply by the percentages, the appropriate percentages. Remember, those are found on page 3 to get the total depreciation. Does that make sense? And I'm in the case study, I'm giving you how much personal property you have, how much building, how much land improvement. That's given. So you've got to apply the percentages. Yep. Matt, that's perfect. I'm not sure what the 1997 would be your tax save. Yeah, and this is just the first year. Remember, this is the first year. Look what that little paragraph at the top says. This is the first year. First year. But that's great, Matt. That's terrific. Now try it for cash. If you finish before everybody else, just try it for cash. That's it, Eric. You're cooking. Everybody's cooking. Even if you're not cooking, text it in or chat it in rather. I wasn't kidding when I said if you can do this, you'll be a superstar. If you can explain it to people, we got to be able to do it, and we got to be able to explain it. April, good. Good, beautiful. That's your depreciation. And so you applied the appropriate percentages, and that's your first year depreciation. Remember, this is the first year analysis. Good, Eric. Brenda, double check now. Double check. You got, remember, there's 3 things to depreciate. There's 4 categories: land, personal property, building, and land improvements, but you're depreciating 3 of them. So it's Brenda, you should have a little more depreciation than that. Yeah, Sarah, that's it. So what would you advise me to do, Sarah? I've got 904,000 to invest. No, Brenda, it's a residential rental building. Look at your building depreciation. It's a residential rental building. Yeah, Sarah, if I have 904,000, don't I have enough to buy 3 of these buildings? Let's say we found a whole bunch of buildings just like this. So I tell if I buy 3 of them, I'd have way more money than if I buy 1. Brenda, do you see what it's your building depreciation that you're using a wrong percentage? You're doing it as if it's a non-residential building, Brenda. It's a residential rental building. That's it, Mike. I don't know what the financed 4.7 is, Mike. That's it, April. No, something's wrong with that one, Mike. Double check. Daniel, let me see. I had to reboot. Okay, Mike, you're back in though now, right? Daniel, I'm not sure. Paid 38. No, something's. You know what? I'm gonna put the answers on the screen. Now, don't just copy the answers, but I want you to double check. Double check as you go. So I'm not trying to torture you. I want you to get this with confidence. So I'm going to put the answers up here. There we go. All right. So take a peek as you work. As you work. Eric, yeah, absolutely. So Eric, just like Sarah, what would you advise me to do and prove it? I came into your office. I said, I've got 900,000 to invest. Present some options to me, I guess, is what I'm asking. It's one thing to get the numbers, and then how do we explain these numbers? What do we do with these numbers? But you're doing great. You're all doing great. I think some of you are afraid to chat in. You can chat directly to me if you want. If you're not sure and you don't want anybody else to see, that's okay. You can do it straight to me, and I'm not going to make fun of any question you ask. I wish I would have known this when I was a baseball player. Yeah, Mike, good. That's it. So now, Mike, try it for cash. Really, those of you who are chatting and actually playing, you're doing really well. Are you getting the depreciation up there? Are you getting 35,089? You getting what I'm getting, and you know where that comes from? Yeah, good. And now, if you finish early, I want to give everybody fair. It's not to see how fast you can do it; it's to get the idea. But then try it for cash also. Just try it for cash. Pretend like I said, okay, I'll buy it for 904 cash. What's my return? Then I don't have any of that nasty old mortgage payment. I'll have a way higher return. That's what the buyers think when they pay cash. But you know different, don't you? And then in the back of your mind, I want you to be thinking, how much is this property worth? Yes, Sarah, that's a good question. We'll talk about that, actually. I think we'll talk a little bit about that. That's, I'm going to save it. I'm going to save it a little bit. We'll talk about it. A good rate of return, there's really no right answer because every market is different. So what's a good rate of return in your market? You'd have to do the worksheet on several properties in your town to know what's good and what's bad. So there really isn't here's the target. That's it, Roz. There you go. There you go, Steve. I'm with you. Take a few more minutes and then we'll go. Take 3 more minutes. Then I want to watch. Now, here's my question. Is this property worth $904,000? If not, how much is it worth? I want you to tell me how much is this worth. Try it for cash now. And if you finish both cash and finance, then just relax and let everybody catch up. That's it, Kurt. That's very good. So Kurt, what would you advise me to do? And prove it with numbers. Prove it with numbers. See if you can do that. But that's great. The numbers you got there is great. Part 2, Brenda, meaning you're paying cash. Yep, that's it. Now you're talking, Stacy. So you'd make 91 versus 52. Plus, if there is any appreciation, you'd have the appreciation on what? 3 rather than 1. What's the right answer? There is no right answer. Can we try it together? Let's try it. Now you're all doing great. I'm impressed by you. I do this a lot and it's not always this way. So chat in your answers, please. But so you can all see my cursor, right? When I move the cursor like this, did you all get 10,168 cash flow? You'd say, Tom, if you buy this property, you get 10,168 cash flow. I say, whoop-de-doo. Can I spend that cash flow? Yes. On what? Anything I want. It's my money. Is it taxable? Yes, it's taxable, but it can be what? Sheltered by the depreciation. We don't find out if it is or not until Roman numeral 3. So I've got 10,168. The second benefit is 18,265. But the principal reduction, 18,265. My tenant pays the loan down, 18,265. When do I get that 18,265? Not till I sell or refinance. It's not a current benefit, but absolutely it's a benefit. My liabilities were paid down by $18,000 by somebody else. When is that taxed? I don't receive the 18,265 till I sell or refinance. When is it taxed? It's not taxable when you sell. It's taxable every year. Both the cash flow, this cash flow right here, this cash flow, and this principal reduction are both taxable every year. Why? What's the logic behind that? Because people will say, I get people who argue. They say, no, the principal reduction isn't taxable till you sell. That's wrong. No. The cash flow and the principal reduction are taxable every year because they come from the tenants. So that's the bad news. They're taxable every year, but they can be sheltered by the depreciation. So the IRS doesn't care about what we've done so far. All the IRS cares about is Roman numeral 3. And to do that, we take the net operating income minus the interest minus the depreciation. And did you all work up here and get 35,089 or $1 to either way of that? It's just rounding in depreciation, 35,089. And that's the number that goes down here. And now if you make this calculation, net operating income minus the interest minus the depreciation, you end up with a taxable income negative 6656. 6656 negative. If you showed me this and you say, hey, Tom, your taxable income's negative 6656. What if I said, I'll tell you what, I'm not in this to lose money. I'll tell you that right now. You'd say, good, you're not losing any money. You actually have 10,168 in your pocket. The tenants pay your loan down 18,265. You're ahead 28,000. You just get to tell the IRS you lost 6656. What created that negative 6656? Depreciation, which is a non-cash expense. What good does that negative 6656 do for me? I can now take it outside the building and use it over here against my income for my job, subject to the passive loss rules, which we're going to talk about. Am I going to save or pay tax? Save. Whenever I'm telling the IRS I'm losing money, you save tax. Will I save state income tax as well as federal income tax? Yes, depending on your state. In a 30% tax bracket, 30% of that is $1,997. And say that's our third benefit. The fourth benefit is appreciation. We'll say nothing. So bottom line, if you add up to figure your return on investment with no appreciation, add up the cash flow, the principal reduction, the tax saved, that adds up to 30,430. Divide that by your investment, which is 253. Did you get about 12% on your money? That's 12% on your money before what? Before any appreciation. Is that good or bad? I don't know. I don't know if that's good or bad. Good or bad compared to what? And you say, well, 12%, come on, that's pretty good compared to money in the bank. Well, yeah, but you cannot compare real estate to money in the bank. Those are two different investments. You've got to compare real estate to real estate. And so you'd have to do the worksheet on several properties in your town. Do this worksheet on several properties in your town, and you'll get a real good sense of what's a good investment, a good rate of return, and so on, what the market is demanding. 12% in this case, before any appreciation. Okay, and this is what I was saying. There's no hard math here, is there? There's not one bit of hard math. You can do this with a 10-cent calculator, plus minus equals, right? And there's not one out of 100 people with a real estate license who can do this. And there are people who have money who are looking for realtors who understand this, and they can't find them. I told you the story yesterday about the guy from Medford, Oregon. He's got $750,000 to invest. He's trying. If you could just explain this worksheet, he'd be your client for life. He can't find anybody. That's a shame. That's a real shame. All right, so here I am, but I'm thinking of paying cash. Did you do it for cash? Did you try this for cash? If I pay cash, what's my rate of return? Right. So let's see if I can get to the cash one. Your cash. If I pay cash, what's my rate of return? And I'm just going to jump through it real fast because what I really want to get to is this property worth $904,000? If I pay cash, I've got $60,568 cash flow because there's no mortgage. I don't have any principal. But now the taxable income is a positive 25,479. So I have to pay tax now. 30% of that is 7644 paid. So down to the bottom, you add up the cash flow plus the principal, take away the tax. You're left with 52,924. You invested 904,000 to get it. That's 5.9% on your money. 5.9. Look at same property, same tenant, same income, same expenses. You do it the first way, you get 12%. You do it this way, you get 5.9. Remember, there's three parts: income, expenses, and financing. The only part that changed was the financing, but that changes the investment completely. What would you suggest to me? Wouldn't you at least suggest this? Say, Tom, I'm not telling you what to do, but let me just show you something, Tom. If you really do have $904,000 to invest, instead of buying one property and earning 5.9, why don't you think about buying three of these? We look with 253,000 cash invested. If I've got 900,000, I got enough to buy three of these and have 100,000 left over. And if I buy three of these, how much money would I have? Well, assuming they're all the same thing, just to make it easy, I have three of the 30,000 430s, right? That's 90,000. Plus I'd have the appreciation on three rather than one. So what's the right answer? There's no right answer. Let me ask you a question. Everybody will play this differently in their own mind. And so you want to present the options, but do you think this? Which do you think is more risky? To invest $904,000 into one property and have no mortgage, or to spread the $900,000 to three properties and have three mortgages? Which is most risky? Well, see, there's no answer to that question. Everybody will play that differently. Some people will say, oh, I don't want the risk of three properties. Other people will say, I want to spread my risk among three properties. I don't want the risk of one property. And again, everybody plays it differently. Everybody plays it differently, but you can show them the return on investment, and that will maybe help nudge their thinking a little bit. Okay, so that's well done. You did great. $904,000. Here's my question to you. Is that property worth $904,000? What do you think? Is that property worth $904,000? What if I came into your office one day? You're on floor duty. I come walking and I say, hey, remember me? You say, no, man, I don't remember you. I say, come on, it's me, Tom. 5 years ago, you sold me a little apartment building down the street. I'm back. I want to list it with you. And you say, oh, Tom, I remember you. How's everything going? How's your wife? Oh, I'm not married. Oh, I remember that. What would you say when I say, how much is this property worth? What would you absolutely not ask me when I say, how much is this property worth? How much I want? How much I want? True or false? How much I want has nothing to do with how much it's worth. True or false? How much I paid for this property has nothing to do with how much it's worth. All right, so how much is it worth? I mean, is that a fair question? Could this happen to you? This could happen to you tomorrow. And now, if this was the house I live in, how would you put a value on it? Wouldn't you compare it to other houses in the neighborhood with a garage and a fireplace that have sold within the last 6 months or something? You would do comparables. You'd do comps. Well, would you believe and agree with me that on a rental property, there's no such thing as a physical comp? That's not what's for sale. What's for sale with a rental property? It's a what? It's a money machine. It's not the bricks and sticks that are for sale. It's a money machine. And so the value of that money machine is based on the parts of the money machine. What are the three parts of the money machine? Income, expenses, and financing. So you'd say, Tom, we've got to mix the income, the expenses, and the financing into a big pot and stir it up to come up with a value. And I say, okay, can you show me how that works? And you say, well, sure I can. Now, do you agree with me that valuing investment property is different than valuing the house you're going to live in? Yeah, and people speak many different languages when valuing investment property. And we, the professional realtor, need to be able to speak how many of those languages? As many as possible. as many as possible. Here, I'm going to put the screen back on. This is so good. I want you to see what I'm saying. As many as possible. And now you would think that the longer we're in the real estate business, the more we get like this, where we're able to speak all languages. Do you agree that's not what really happens? Typically what happens is the longer we're in the real estate business, what happens? We get narrow, narrower. Narrower. Here's how I do real estate right here. If a customer comes across my path, I got a customer. Well, is there a whole bunch of real estate out here? And the more of this we can know and understand and explain, the better we are at our practice, and the more people will seek us out. So I want to talk with you about how to value an investment property. Turn to the next page. Turn to page, what is it? Page 5. Turn to page 5. And on page 5, look what it says. How to value a rental property or a business. And you know, it shouldn't even say or a business. A rental property is a business, right? And on that page, I've got 3 different methods of valuation that people use, 3 different languages that people use. And under each language, it says, what's the formula? Then under that, it says, what's the limitation? Does not take into account this, or this. Remember, a rental property is a money machine made up of 3 parts: income, expenses, financing. Which of those parts is important? All 3. How many of those parts do you think we ought to use? All 3, right? Well, let's talk about each of these. So turn in your book now. Have this worksheet by your side, this $904,000 worksheet. Keep it right there, because we're going to use these numbers. We're going to use these numbers. And so on your page 5, look at that first method of valuation. That's that gross multiplier. That's the gross multiplier. Remember, we talked about that a little bit yesterday. The gross multiplier, that's where people say, I pay X times gross. Have you ever heard people say that? I pay 6 times gross or 8 times gross. You know, you'll talk with somebody who talks that way, or you'll see ads in the newspaper, you know, 6 times gross or 8 times gross. The gross multiplier. The gross multiplier, that 1% rule that I talked about yesterday, that's the gross multiplier kind of in reverse, where people say, well, a rental property ought to rent for 1% of its value a month. That's a bunch of baloney. So a property that rents for $1,000 a month is worth $100,000? No, get out of here. That's crazy. Well, the formula for gross multiplier, there are people who speak this language, so we got to be able to speak it. So write the formula with me. The formula is the cost divided by the gross operating income. It's the cost of the property divided by the gross operating income. Now, let's say that you have this $904,000 property listed for sale. And I call you up and I say, $904,000 for this turkey. What's the gross multiplier? Would you take a moment and figure it out? Use the numbers on the worksheet we just did. We're going to use those numbers over and over. We're going to work this worksheet all the way through. The cost divided by the gross operating income. Are you getting what I'm getting up there? Right? Wouldn't it be your cost, 904,000 divided by the gross operating income? That's your income after vacancy. If you do that math, you get 8.21. 8.21 is the answer. What's the question? We'll do it like Jeopardy. I'll say the answer, 8.21. What's the question? Put in question format, please. What is the gross multiplier? Oh, it's 8.21. What does this mean? It's not a percentage. It's not a percentage. What this means is if you bought this property for $904,000, you would be paying 8.2 times the gross income it collects. That's all it means. What do you think of gross multiplier as a method? What do you think of gross multiplier? It stinks. It stinks. How do you know it stinks? How do you know from everything we've talked about the last 2 days that it stinks? You're buying a 3-part money machine and you're only analyzing how many parts? 1. It takes into account the income. What about the other 2 parts, the expenses and the financing? Oh, it doesn't even take those into account. So where it says limitation, you see underneath the formula where it says limitation, put does not take into account expenses or financing. Does not take into account expenses or financing. And how about those 2 minor variables? Well, they're not minor. They're not minor. Okay, so people say, all right, I'm not falling for that gross multiplier deal. I'll tell you that right now. And they use another method called capitalization rate. Capitalization or cap rate. Have you heard that term before? The cap rate, capitalization rate. So many people use cap rate that I've got the formula down at the bottom of your worksheet. I put it on the bottom of the worksheet. So many people speak that language. But let's put it in both places. The formula for the cap rate is nothing more than the net operating income divided by the cost. It's the net operating income divided by the cost equals the cap rate. So it's a rate. It's expressed as a percentage. If I call you up and say, hey, all right, 904,000 for this thing, what's the cap rate? Take a moment and figure it out. Carry it out a couple decimals now. Carry it out a couple decimals. What's the cap rate on this property? Now be careful. We're using the net operating income. Chat in your answer when you get an answer before I put it up there. Yeah, Stacy, that's it. That's it. Carry it out a couple decimals. Jason, that's it. Yeah, good, everybody. You're doing good. Are you getting what I'm getting on the screen now? You're getting 6.7%, depending on how far you carry it. Yeah, wouldn't it be this? Wouldn't it be the net operating income, which is 60,568, divided by your cost of 904,000, you get 6.7%. It's a 6.7% cap rate. What do you think of cap rate? Not what do you think of 6.7, but what do you think of cap rate? Good method, bad method? Well, better. How do you know it's better? How do you know it's better than gross multiplier? It takes into account what? It takes, remember, it's a three-part money machine: income, expenses, and financing. The gross multiplier does not take into account the expenses or financing. What about the cap rate? What does the cap rate take into account? The gross multiplier does not. It takes into account the expenses, right? Because we're dealing with the net operating income, right? Net operating income. So it takes into account the income and the expenses. What doesn't the cap rate take into account? It does not take into account the financing. So where it says limitation put does not take into account the financing. And how important is the financing? It's pretty important, isn't it? Pretty important. Here, wait. Now we're borrowing money here. We're borrowing money on this one at what? 5%. 5%. So we get a 6.7% cap rate. What if we had to borrow money at 9%? Now what's the cap rate? 9%. We're borrowing not at 5% anymore. We're borrowing money at 9%. What's the cap rate? It's the same. It's the same. Ooh, what if we could borrow money at 3% though? Now what's the cap rate? It's the same, 6.7. The cap rate's the same whether you borrow the money at 3, 9, or 5. And yet those would be completely different investments. And so the problem with the cap rate is it does not directly take into account the financing. It assumes you pay cash. It assumes you're paying cash. You know who uses cap rates the most are the big guys, the real big guys. I mean, the insurance companies, the pension funds, because they most often buy property how? Cash. They write a check, and this would be the return on their cash. Even us little guys can use cap rate. Even us little guys can use cap rate. Can I show you how? Can I show you how? Here, think of this. Think of this. Don't even write it down or anything. Just put your hand on your chin and just stare at the camera with your hand on your chin. And if I say something interesting, I want you to go, Okay. Now think of this. A 6.7% cap rate means. What does that mean? 6.7% cap rate. All it means is if you buy this property for $904,000. This property produces 6.7% of its cost in net operating income. The property produces 6.7% of its cost in net operating income. If you have trouble sleeping at night, you go down to the bookstore and there you could buy a 300-page book about cap rates. Don't do it. Don't do it. I've already read it. It's awful. It's little tiny graphs and charts, and or if you have trouble sleeping, you keep this on your nightstand. You wake up at 3 a.m. and think, oh, I can't sleep. I know, I'll read a little of this cap rate novel. You read 2 paragraphs of that, you'll be dead till noon. They won't even be able to wake you up. Here's what it says. Here's what all 300 pages say. If this property, 6.7% cap rate means the property produces 6.7% of its cost in net operating income. That's all. That's what all 300 pages say that. Now think about this. Here's the aha. The property produces 6.7% of its cost in net operating income. The net operating income is the amount of money you have available to do what with? Look at the worksheet. Out of that net operating income, what do you have to do? You got to pay your debt and you got to pay yourself. You got to pay your debt and yourself out of that 6.7%. You with me? Therefore, the capitalization rate is the highest rate you can afford to pay for your financing before you have what's called negative leverage. Negative leverage means the money costs more than the property's producing. And how are you going to make any money doing that? And the answer is you're not. If you want a real fast way of analyzing a property, look at the capitalization rate and look at the cost of the money. The money better cost what? Less. And the lesser it costs, the better. So, forget the math, forget all the math. Look at this. A cap rate is a measurement of how strong the property is. Do you remember if you go down to the carnival, go to the carnival or the fair comes through town, you go down to the fair and you're walking through the fairgrounds and there's the guy with the giant sledgehammer, and the pole that goes up with a bell on the top, and you take the sledgehammer and you hit the thing and see how high the thing will go up to the bell. Well, the property says, all right, give me that sledgehammer. And the property swings and goes, and it goes up to 6.7%. So the property is 6.7 strong. So the loan says, all right, you give me that hammer. And the loan goes, and in this case, the loan can only hit it up to 5%. So the property is stronger than the loan. That's a buy sign. That's a green light. And the stronger, the better. Now, what if the opposite was true? What if the property was 6.7 strong, but you had to borrow money at 7? Now what happens? Now the loan is stronger than the property. You don't want to buy property that way. You're going to lose money. You're going to lose money. Do not buy property negatively leveraged, because you could what? You could borrow too much money and sink the ship. You could absolutely sink the ship. And so if you want a fast way to measure a property, look at the cap rate and look at the cost of the money. The money better cost less, and the lesser it costs, the better. Does that make sense? So in this case, look at this. We've got a 6.7% cap rate. That's how strong the property is. The loan, how strong is the loan? 5%. That's a green light. That's a proceed with caution sign. All right. Now, can you see how many of you believe interest rates will rise in the next few years? Well, if you in your heart of hearts believe interest rates will rise and you have adjustable rate loan on your rental property, with all due respect, you don't know what you own. You're at the complete mercy of the financing market, because could you see interest rates rising and the income on the property not rising as fast, and it could sink the ship. In my opinion, if you're buying with an adjustable rate loan, you should analyze it from the worst interest rate it could be, not the best interest rate. And so a lot of times people buy a rental property and kind of fool themselves, because they'll get a property with a low interest rate, for the first 2 years, and then it's going to adjust. Well, every time as that financing adjusts, the value of that building changes. The value of that property changes, and you could end up being burned. You could end up being a really good investor and get burned by the financing, not by the property. So the problem with cap rate does not directly take into account the financing. So people say, okay, all right, cap rate's better, but it's not great. So they use another method called cash on cash. Have you heard that term before? Cash on cash. The people who use cash on cash, myself included, have this attitude. We say, well, yes, there are 4 benefits to owning investment property, but if you think about it, 3 of those 4 benefits you cannot even count on. The appreciation, I don't know if there's going to be any appreciation. The tax savings, those people could wake up in Congress overnight and change those rules. I'm not getting caught in that. The principal reduction, get out of here. I don't even get that till I sell. The one benefit I can count on is cash flow. So people say, if the money machine produces enough cash flow, the other benefits will take care of themselves. And I think that's a fairly rational way to look at it. And so the formula for cash on cash is nothing more than the cash flow divided by the cash invested. How much cash are you earning measured against, not the price you pay, measured against the cash you invest? Cash on cash, cash earned on cash investment. Now, the cash on cash is used so frequently, I have it on the bottom of the worksheet because so many people use it. But let's put it in both places. Put it in both places, please. All right, I call you up, 904,000. You got this property listed for. I say, all right, 904,000. What's my cash on cash return? Take a moment and figure it out. What's my cash on cash return? Carry it out a couple decimals. Be careful now what income you're using now. We're using the cash flow. What's my cash on cash return? Yeah, Matt, that's it. You getting what I'm getting up there? We're going to be the cash flow, which is 10,168, divided by, not the price, not the 904,000 the price, divided by the cash I invest. Cash earned measured against cash invested. So it's 10,168 divided by the 253,000. Are you getting 4%? That's a 4% cash on cash return. What do you think of cash on cash as a method? Not what do you think of 4%, but what do you think of cash on cash as a method? Good method, bad method? It's good, isn't it? How do you know it's good? How do you know it's the best one so far? Yeah, it's the last one we're doing. Yeah. But how do you know? How do you know? How many? It's a 3-part money machine. How many parts are we taking into account when we do cash on cash? We're taking into account the income, aren't we? Yeah, because we're using cash flow. We're taking into account the expenses. Yeah. We're taking into account the financing. We're taking all three into account. It's the best way to analyze a property. It's the most complete way to analyze a property. Think of the cash on cash return as a dividend. It's like a dividend in a stock. Here, this rental property would pay a 4% dividend on your cash invested. And what about the other 3 benefits? The principal reduction, the tax savings, and the appreciation. Those are over and above your 4% dividend. Okay. Now, what a good investor, the best investors, let's say, will have a target cash on cash. Some of you asked me earlier, what's a good return? Well, overall return, you'd have to check the market. But a good investor will say, I want X% cash on cash. If I can get X% cash on cash, I'll buy all day long. If I cannot get that cash on cash that I demand, I'm not going to buy. I'm going to wait. And I think that's a fairly good strategy. So shouldn't we be able to start with the cash on cash return that the market demands and work backwards to figure the price? Shouldn't we be able to say, okay, the market demands X% cash on cash. Whoop, what price would give us that cash on cash? How many would like to be able to do that? Yeah, even if you wouldn't like to be able to do that, turn to page 6, and I'm going to show you how to do that. And I'm going to make you think a little bit now. Page 6, look at case study number 3 on page 6. Case study number 3. All right, let's read it. You receive a phone call from an investor who is interested in one of your listings. I'm on page 6, case study number 3. You receive a phone call from an investor who's interested in one of your listings. The investor says she will purchase the property if she can receive a 10% cash on cash return. Is that a reasonable position on the part of Maggie, my friend Maggie, the investor? She's not buying unless she gets 10% cash on cash. What that means is her first benefit, the cash flow, has to be 10% of her cash invested. That's her target. Given the following information, what price will meet the investor's goal? The property type, it's a little shopping center. The net operating income is $50,000 and the available financing is 25% down, let's say 10% interest to make it easy, and 15-year amortization. Here's my question to you. I want you to take a few moments and noodle those numbers around, and you tell me what price, if I'm the guy, let's say I'm Maggie, what price could I buy that property for and get my 10% cash on cash and get the loan paid back over the 15 years? All right. And I'll make you a deal. The first person with the right answer to within $5,000, I'll give you my 4-part video free. All right, go ahead. All right, time's up. No, I'm kidding. I'm kidding. You go ahead and do it. I will. First person with the right answer within 5,000, I'll give you that 4-part video series for free. Go ahead and do it. Chat in your answer now. Don't try to figure anything out till you figure out what you're trying to figure out. Right? What's the question here? We're looking for a price. We're looking for a cost. What cost can I have to get my 10% cash on cash and get the loan paid back? All right, go ahead and do it. Chat in your answers now. Chat in. Could this be a fair question? The answer is yeah. As soon as you think you're never going to use this stuff in your life, who's going to, first person you're going to meet? Somebody who's interested in this. People will pay you for this. All right, I'm going to be quiet. Chat in your answer though. We gotta have some chats. Somebody do it. I'm not going to make fun of any answer. If you want to just chat it to me privately, that's fine too. Wait. Is there enough information to do this? Is there enough information in this case study to do this question? Yes, there is. There is. I know it doesn't seem like it, but there is. Everybody on this webinar is going to be able to do it by the time we're done. We're going to be here till 9:30 tonight, but you're all going to be able to do it. I'm looking for a price. Give me a price. What price? Come on, somebody do it. I've got to get my 10% cash on cash and I've got to get the loan paid back over the 15 years. And it's a 10% interest loan. Somebody do it. Chat me in. Come on. Chickens. April, no, that's what everybody thinks, 500,000, but see, that won't do it. 500,000, no, a million, no. Keep trying. Now, if I say high, low, we're gonna get it, aren't we? I'm looking for a price. What price can I buy this property for and get my 10% cash on cash? Yeah, 2 million, no, Matt. Daniel, no, but thank you for guessing. Thanks for playing. That's good. That's good. Keep trying. It's fun. You can't be wrong. Well, you can be wrong, but it's not, there's no consequence to it in here. Nobody's got it yet. Come on, I want to give away the 4-part series. Jason, no, it's a little high. Mike, we're page 6, question 3, case study 3. Jason, no. Alicia, no, not quite. Oh, yeah, Brenda, that's the one everybody thinks is 500,000. Now, do you agree with me? This is a real world question. Yeah, absolutely. Absolutely. And there are people who will pay you to do this. Is this a fair question? Absolutely, it's a fair question. So now think about this. We've got answers. We got everybody chatting in, and that's great. We've got answers ranging from 500,000. We have 700,000. We have 1 million. We had 2 million. So we've got anywhere from 500,000 to 2 million. So we've got it narrowed down. You think we ought to tighten it up a little bit? What have you said to your client? Well, you know, it depends on the market, but it'll be somewhere between 500,000 and 2 million. Well, let's see if we can narrow it down. Wouldn't it be cool if there was a neat little worksheet to do this automatically? And the answer is yeah. And I'm going to show you that worksheet right after this 13-minute break. Take a break. Take a break. 13 minutes. And so we'll only take 2 breaks this morning. So 13 minutes, get away from it and come back in 13 minutes. And I'm going to show you how to do this.
Brenda, do you have a headache? I can't hear you. Do you have a headache?
I hate it when I can't figure something out. I'm like, oh.
You'll get it. You'll get it.
I'm like racking my brain, trying to look in every direction. And I'm like,
Well, that'll be one nice thing about the video. You can watch it and you can stop it. You know what I'm saying?
Uh-huh.
If you need, How are you doing?
I have a hard time quitting when he's like, take a break. I can't take a break. I don't know the answer.
Oh, you will get to it. Do you have rental properties?
Yeah, we do have properties, but ours is kind of a different. I thought about sometime calling him and talking to him about it. But like with our properties, for the most part, we're trying to save old houses. So all of our properties are 100-year-old properties. And so we're going in and we're redoing electrical, redoing plumbing. So most of ours are pretty well projects. But we're trying, wanting to save the old woodwork and
Some
improving them.
Have beautiful woodwork.
Yeah. But we have one of them that is a 5-bedroom, and actually what we want to do with it is I found out in North Platte there's actually a lot of homeless high schoolers that couch hop or live in their cars. And so
sad.
I talked to the school about it. We have a foundation, and I was talking to them about it, and they said the majority are girls. So I really feel that the Lord's led me with one of our properties that I want to rent it out by room and for a place, but then, they have to have a job. So I'm keeping them responsible, but we could probably in a dorm room type of style, put 8 to 10 girls in there.
That would be awesome.
And then they could just split the rent per room, but we'd have to furnish it. And so where was talking about splitting it with the personal property and stuff, where we're having to furnish it. So kind of thinking about that, or if he has any ideas of options or to help with the process, or trying to figure it all out.
Yeah, that's such a cool idea. Is there any way that the Lincoln County Board of Realtors could help you out with that and be a part of that?
I don't know. I guess I didn't really.
I think that would be something really cool to be a part of. As your board. What a great opportunity.
You might also check into like the NAR, like national realtor stuff. Sometimes like they have different grants. I don't think it would necessarily be a placemaking grant, but I don't know, Christy, can you think of any of the national?
That's true. Good point. Good point, Stacey.
Okay.
There might be like a housing type of grant that might help you get some extra cash.
Okay.
I'll see if I can look online real fast.
Yeah, there you go. Stacey, look.
Yeah, so I'm like, there's got to be something how we're going to use the property to be able to get help to get it done faster.
Yeah.
I'd like to have it done before school starts again.
Are these kids, Brenda, that
2-minute warning, everybody. 2 minutes. We'll go to work.
Don't live with their parents anymore, or?
Well, and there's so many broken homes anymore that you kind of wonder if the majority's girls, what's going on?
Right. Yeah. Good point. Good point. And that's sickening.
And so, and I thought, okay, once a month I can be like, okay, girls, we're going to clean house. And, if they're not being raised in a home, they're not learning those things. So I'm almost kind of looking at it as a ministry.
Right.
But we're doing it that they have to pay rent because we do have a mortgage on it. So,
Yeah, I don't know. Did I tell you that the GRI 102 instructor, basically, he does construction work
Mhm.
in Minnesota, and he helps inner city kids in Minnesota do carpentry work. And
Oh,
so
cool.
he's teaching them skills, kind
Yeah.
of like what you're talking about doing. You know what I'm saying?
Yeah.
Teaching them skills so they have something that they can use when they get out into the real world. But
Yeah.
they're very similar to what you're talking about too. You know, they're younger
Mhm.
kids that have no direction in life, you know, and
Mhm.
you have kids yourself, right?
Yeah. Yeah. I
How
have two of
many?
my own that are in school, and then I have two bonus kids that are adults.
Nice, nice. Huh.
But
That is so awesome that you're doing that. Seriously.
it really broke my heart when I found out that there was that many. I went and talked to the school and I'm like, well, what can I do?
Yeah.
And then I was thinking about our properties and I'm like, oh, well, one of them that
Let's go
would
back,
work out
let's
really
go back to
good.
work, everybody. Brenda, I've heard that conversation. I'm glad to help if I can help, give you some ideas if you just want to talk about it
Okay.
sometime.
Yeah,
So-
I'll give you a call.
Yeah, that's very cool. So congratulations. So hopefully some of this stuff might apply and help you.
Yeah.
All right.
I think you should take them all down to Wisconsin and you can teach them how to cut firewood.
Yeah. All right. You know what? I live in the woods in Wisconsin, and right outside my window during the break, an owl landed on the branch. So I was looking at an owl, which is really cool. And he's
Cool.
turned his head completely around and was looking at me. All right, we got to go back to work though. Got to go back to work now. So what we
Camera's
did,
on.
what?
I said camera's on.
Oh, camera's on.
If you
Yep.
forget, sometimes they get back from break and they forget because they're
I
so
got you.
excited. They're so excited to work with you.
Yeah, that's true.
And so they forget
Yeah.
to turn their camera on.
Now, I better turn my camera on too. I'm so excited to work with you. All right, now let's go back to work. So we truly do have answers ranging from now 325,000 up to 2 million on the same set of same question. And this is in a room full of people who are licensed to help people with the stuff. So think how the people out there in the marketplace need our help. And so I'm kidding with you a little bit. If you don't know how to do this, of course you wouldn't know how to do it. I mean, if you've never done it, but you'd like to be able to do this, wouldn't you? I know you would like to be able to do this. I want to show you how to do this. And there are people who will pay you to do this for them. Now, think about, let me just tee it up for you a little bit. Think about this. With most investment properties, how many investors are there? Most investment properties. There's two. There's two. There's the buyer, Maggie, and then there's lender, the buyer and the lender. Isn't the lender investing every bit as much as Maggie, the buyer? Yeah, even more in this case. The lender's putting in 75%. Maggie's only putting in 25%. So there's the lender and then there's the buyer. The property has to satisfy which? Both. It's got to satisfy both. If it doesn't satisfy the lender and the buyer, the whole thing falls apart. It's not going to work. Think about this. The value of a rental property is made up of two things: down payment and loans. Down payment and loans. I'm going to show you a worksheet. Turn in the back of your book and look for a float and desire worksheet. It's another one of my worksheets. Float and desire. You got a bunch of the investment property worksheets, and then you've got a float and desire worksheet. Okay, here I'll put one up here. That's not it. Here it is, right here. Float and desire. Now, these are my words, the float and desire worksheet. Don't go to your accountant and say, I'm doing that float and desire thing. They won't know what you're talking about. Sounds like a waterbed commercial. But now think about this. With most investment properties, there are two investors. The property ought to satisfy both. And valuing investment property is exactly like baking a cake. I am not a master chef, but I know enough about baking a cake that I know you just don't throw all the ingredients into a pot and stir it up and cook it, and you got a cake. don't you put the ingredients out on the countertop, mise en place, and then you mix a little of this with this, and you blend in this, and you fold in this, and you stir it, and you bake it, and you have a beautiful cake. Well, the same is true with the rental property. Float and desire, these are my words. The value of property is made up. The float is how big of a loan will the net operating income keep afloat. The desire is how much do I desire a property like that? How much am I willing to take out of my pocket and invest in a property? If we figure how much cash investment we have and how big a loan we can keep afloat, if you add those two together, wouldn't you have the price? Wouldn't you have the cost? And the answer is yes. Well, 5 ingredients. We have to know these 5 ingredients. And do we know these 5 ingredients from the case study? We need to know. So tear out the float and desire worksheet. So you have one by your side. And at the top of it, put case study number 3, page 6. Just so if you pick this up a month from now, you realize, okay, here's where the numbers come from. All right, let's fill in what we know on this property. We know the net operating income is $50,000. So fill that in with me. All right, now the target cash on cash is 10%, right? Maggie's not buying unless she gets 10%. And so let's put 10%. Now use decimals, 0.10 be 10%. All right, now what financing is available? We know we have to put 25% down, so put 0.25. And if the down payment's 0.25, we know the loan to value is 0.75, right? And then the only other thing we have to bake into this cake is somewhere we have to tell it that it's a 10% loan for 15 years. Because would a 10% loan for 15 years bake a different cake than a 9% loan for 30 years? Yeah. Well, what is something that takes into account the rate and the term on a loan? Have you ever heard of a loan factor or a loan constant? A loan constant. When we negotiate our financing for investment property, you negotiate with the lender, you negotiate the loan constant, the loan factor. You know what? Even if you've never heard those terms, you've seen loan factors. How many of you have ever seen somebody who on the back of their business card, they have the rates per thousand on a mortgage? You ever seen something like that? Those are loan factors. Those are loan factors. Every loan, depending on the rate and the term, has a factor. And now you can easily figure loan factors, but I've got a whole table of loan factors for you. Turn to page 9. Take a look at page 9. And on page 9, I've got a table of annual loan factors. And so in this case, it's 15 years, 10%. Go to the 15-year, 10% down there in the corner, and you get 0.1289526. Everybody see where I am? 0.1289526. What is the 0.1289526? What is that? 0.1289526. It's not the interest rate. What's the interest rate? 10%. No, you know what the loan factor is? It's the interest and principal rate. See, if Maggie buys this property, she cares about paying the loan back. And so you care not only about the interest rate, you care about the interest and principal rate. So 0.1289526 takes into account that it's a 10% loan for 15 years. And what that means is every dollar you borrow, the payment on that dollar, the annual payment will be 0.1289526. So if you had a $70,000 loan and you multiply it by 0.1289526, that'll give you your annual debt service. And you think, oh man, I got a headache. Come on, you're killing me. If you have a financial calculator, how many of you have a calculator that'll figure mortgage payments and you know how to do it? If you look at the top, the paragraph at the top, to calculate the annual loan factor, determine the monthly payment for a $1 mortgage and multiply by 12. Every dollar you borrow. And so carry your answer out several decimals. So you can double check any of my answers there. So you figure the payment on a $1 mortgage and multiply by 12. The reason we multiply by 12 is we have to use annual loan factor because we're using annual net operating income. You can't use annual loan factor with monthly net operating income. That wouldn't work. All right, so now where would you get all these ingredients? You wouldn't buy this unless you get these ingredients. Well, the net operating income, where would you get that? You get that from the Schedule E. What about the cash on cash? Well, in this case, it comes from the buyer. Maggie's not buying unless she gets 10% cash on cash. But if you were listing the property, you'd have to keep track of what cash on cash. You would do comps But you're not comping prices, you're comping what cash on cash return is the market demanding. In my office, we keep track of cash on cash in a couple different markets, and you'll see an amazing consistency to that. You'll know what does this property have to produce to attract money. And then the down payment, the loan to value, and the loan factor, you get those from the lender. You get those from the lender. And so the financing will absolutely change the formula. All right, so once you know these 5 ingredients, the question is, okay, so what's the recipe? We'll look at the next little paragraph. The 4-step recipe. The first step is to satisfy the lender. Let's figure the lender's return. Well, of those 5 ingredients up on the top, which is the lender most concerned with? The lender's concerned with the loan to value, right? The LTV, loan to value, which is 0.75. So fill this in with me now. 0.75, all right? And then the lender's concerned with the rate in the term. Well, what takes into account the rate in the term? The loan factor, which is 0.1289526. So if you do this now, if you multiply the loan to value times the loan factor, what do you get? You'll get a number that represents the lender's return. What do you get? Then carry it out. I'm doing 7 decimals. The more decimals, the more accurate you'll be. What do you get? Do you get 0.0967145? 0.0967145. What is that 0.0967145? That's a number that represents the lender's return. The lender's happy if this property can produce 0.0967145. That would be 9.67%. The lender's happy. But so we got the lender happy, but who else has to be happy? The buyer has to be happy. Maggie. Well, of the remaining ingredients, which of those is the buyer most concerned with? She's concerned with her down payment, which is 0.25. And she's concerned with her cash on cash, when in this case is 0.10. So if you multiply the down payment, 0.25 times 0.10, you'll get a number that represents the buyer's return. If you do that math, did you get 0.025? The first step is the lender's return. The next step is the buyer's return. The property has to satisfy which? Both. So look at the third technical step. Add up. So we take the lender's return, which is 0.0967145, plus the buyer's return, 0.025. If you add those together, that'll give you the return the property has to produce to satisfy whom? Everybody. If you do that, did you get 0.1217145? Or in this case, it would be 12.17145. What is that 0.1217145? What is it? It's the cap rate. It's the cap rate that'll make everybody happy. 0.1217145. If this property can produce a 0.1217145 cap rate, everybody's happy. Now, do you remember earlier we said the problem with cap rate is it does not directly take into account the financing? But look at this. We just tricked the cap rate into taking account the financing. See, the cap rate says, oh, I can't do that financing. I can't take into account the financing. See, the cap rate is like many of us on this webinar, much unused potential. With a little bit of effort, the cap rate can take into account the financing. So once you know the cap rate, what's the only other ingredient we haven't used? The net operating income. So look at step 4. Step 4 is we take the net operating income, $50,000, and we divide. That's a divide sign. If it's not clear, that's a divide. You divide by the cap rate, which is 0.1217145. And if you do that math, you'll get the investment value of that property that'll give you 10% cash on cash and get the loan paid back over the 15 years. Go ahead and do it. Carry it out as many decimals as you can. What are you getting? I'm going to let you do the math. You getting what I'm getting up there? Getting 410,000. Now be real careful of your decimals. Is there a big difference between 0.1 and 0.01? Yeah, like 10 times. So are you getting 410,797 or so, depending on how far you carry it? Yeah. The more decimals, the more accurate you'll be. What is the 410,797? That's the investment value of this property, priced to a market that demands 10% cash on cash, financed at 10% interest, 15 years. Does that take into account the income, the expenses, and the financing? Yes, yes, yes. If you change any one of those variables, does that change the investment value of that property? Yes, yes, yes. But it'd be easy. All you do is change the ingredient, and then you put it into the recipe, and that'll give you the new investment value. Income, expenses, and financing. This will make you a lot of money if you can do this, if you can explain this to people. I know there's a lot of numbers. I know there are, and I know everybody doesn't love numbers. I understand. Stand back from the numbers. Let your calculator do the numbers. 410,797 is the investment value of that property. Okay. Does that take into account income, expenses, and financing? Yeah. What if I said to Maggie, what if I was Maggie's investment advisor? I said, Maggie, just buy it. Pay 410,797. Trust me, it'll work out. Is Maggie going to trust me? What if I said it to you? I said, just pay the 410,000. It'll work out. Trust me. You're not going to trust me. Don't trust me. You should double check the numbers, right? Because look at what we've done here. We have used decimals to come up with a dollar answer. Shouldn't we be able to double check our answer using dollars? So the bottom part of the worksheet is a double check. And so let's do it. We're going to double check that our answer is correct. We take the investment value, 410,797, all right, minus the down payment. Well, how much is the down payment in dollars here? Chat it into me now. What's the down payment in dollars? Remember, look up at the top what we got to put down. What percent do we have to put down if we're Maggie? Yeah, wouldn't it be 25%? 25% of 410,797 is 102,699. 102. So we subtract the 102, you're left with 308,098. And that's the amount we have to borrow. Isn't this the deal as it's presented to Maggie? 410,000, she's got to put 102,000 down and borrow $308,000. That's the deal. Now, is Maggie willing to take 102,699 of her own money out of wherever she's got it now and invest it into this money machine? She is, but only if she gets what? 10%. Otherwise, no deal. Maggie says, I'm not buying unless I get 10% cash on cash. So the next little paragraph, let's make sure we can get Maggie her 10% cash on cash. So we take the down payment, which is 102,699, and multiply by her cash on cash, which is 0.10, and you get 10,270. And that's got to be the cash flow. Maggie is not buying unless she gets $10,270 in cash flow. Where does that cash flow have to come from? It's got to come from the property. It's got to come from the net operating income. So the last paragraph there, we take the net operating income, which is $50,000, and take away Maggie's cash flow. Take away 10,270 and put that in Maggie's pocket. That's Maggie's. And what you've got left is 39,730, and that's the amount you can afford to use to pay your debt service. Okay. Now the question is, how big of a loan will 39,730 keep afloat? Remember, float and desire. The desire is 102,000, Maggie's cash, but how big a loan can we keep afloat? Well, how big a loan do we hope we can keep afloat? We hope we can keep afloat a 308,098 loan up here, remember, because that's what she's going after. Well, to figure how big a loan you keep afloat, all you do down here is divide your debt service by the loan factor. The loan factor in this case is 0.1289526. Go ahead and do that. And that'll tell you how big a loan you can keep afloat with 39,730. Go ahead and do it. 39,730 debt service, divide by your loan factor. And if our answer is right, we should come up with 308,098. Did it work? Yeah, Jason, so go ahead and do that. Do that math. That's the formula. So you're taking the 39,730 debt service, divide by the loan factor, and you should get 308,098. If our numbers are right, the worksheet's in balance at 308,098. And look at the blue line. What it's saying, is if ever you do this, if the loan you can keep afloat does not equal the loan you're going after, you know something's wrong. The worksheet's going to say, stop, something's wrong. You made a mistake. In this case, though, we didn't make a mistake. It's in perfect balance at 308,098. What did we just prove? We proved that if Maggie buys this property for 410,797, she can put 25% down. She'll get 10% cash on cash, and there's enough net operating income left over to keep afloat the loan. Everything's in perfect balance. Income, expenses, financing. What if the seller says, I got to have $450,000 for this thing? What's the seller done? It's out of balance. Something's wrong. Or what if the lender says, we got to have a higher interest rate? Well, then it's out of balance and you got to redo it. Now in my video series, I've got a program for your calculator that'll do this just that fast. But here it is. You don't need a calculator. I mean, a fancy calculator. You can just lay it out just like this. And you know, it's in perfect balance at 410,797. This is how many of you have a kid at home? A kid, or my wife doesn't want to say kid. You have a child at home. You come home and your child says, oh, Father, welcome home. Anything I can get for you? It's actually, hey, Dad, you got $10 in the car keys. $10, you got $50 in the car keys. Well, do you remember when the kid was a little baby? Did you ever go to the toy store and buy one of those mobiles? You know what I mean by a mobile? It's a kit with strings and sticks, and you hang things. You hang the ducky here and the piggy here and the horsey here and the cow here, and you hang it above the baby's crib, and the baby thinks it's real cool. Yes, this is a mobile, and this mobile's in perfect balance at 410,797. What if the seller says, I got to have $450,000 for this thing? What's the seller done? The seller's moved the ducky. So what do you have to do? You've got to adjust the piggy. Folks, here is big time commercial real estate in one sentence. You cannot move the ducky without adjusting the piggy. Next time you go on a listing presentation on a rental property, you give them one of these and they'll be afraid of you. They'll sign just to get rid of you. You cannot, now I'm kidding with you, but you cannot change one of these without affecting the whole thing. True or false? True, it's true. You know what? I got a phone call from a guy, just thinking about this, I laughed. I got a phone call from a guy a couple years ago. This guy was from Austin, Texas. And he called me up and he said, hey, Tom, you don't know me, but I want to tell you a story. I said, okay. And he had bought my 4-part series. And he said that he had been attempting to buy a little shopping center in Austin, Texas. And it was REO, real estate owned by the bank. You know, the bank had foreclosed on it and they were marketing it. He was trying to buy this little shopping center. And he said, I could never make a deal with the lender. I could never make a deal. They wouldn't finance. I couldn't make the numbers right. And so this went on for several weeks. Finally, on a Friday afternoon, he met with the banker at the property. And the banker said, all right, I'll tell you what, we'll sell it for this price. We'll finance it this way. And so the guy said, Tom, I took your worksheet. And it worked. I got my cash. He said, okay, finally, we got a deal. And the banker goes, oh, all right, finally. And the banker's, it's Friday afternoon, nothing we can do today. You come into my office next Tuesday and we'll sign everything over to you. And it's yours. All weekend, the guy's real excited. He finally bought the property. Tuesday afternoon, he goes into the banker's office, and there's another big desk with a big stuffed fish. And he says to the banker, now here I am, I'm ready to buy that shopping center. And the banker goes, oh, yes. Here's the file, and reaches across and he slides the file across the desk. And the banker said, we need you to sign here and sign here. And then it's yours. Oh, by the way, the banker said, over the weekend, the Federal Reserve raised interest rates a 1/4 point. So it's not our fault, but the feds, they raised interest rates 1/4 point. So we've got to follow along. So everything's the same as we talked about last Friday, except the interest rate is a 1/4 point higher. So we need you to sign here and sign here. And the guy said, all right. He said, Tom, I took your formula. And he said to the banker, then I cannot pay you what we agreed on last Friday. Now I can only pay you this much. And the banker said, no, man, come on. We had a deal last Friday. What are you doing changing the deal? He said, Tom, I did it just like you taught me. He said, I looked them right in the eye And I said, you move the ducky. And this guy was great. He was from Texas. Ducky was like 3 syllables. He said, I told him, you move the ducky. And the banker said, what? He said, you move the ducky. I get to adjust the piggy. And they went through, they were laughing, they were crying, they were laughing so hard. But the bottom line is he bought it at the reduced price. You cannot change one of these without affecting the whole thing. True or false? True. True. What we're determining here is a property's investment value. And now some properties have 2 values. Like what? What kind of property would have 2 values? A house. A house. See, a house has a home owner value where a person would live, or it has an investment value. And they're not the same. Necessarily, they're not the same. How many of you know people who buy rental houses, who buy houses and use them as rental properties? That can be great, but they better darn well buy it at the investment value, not necessarily the home owner value. So a house has 2 values. So I want to show you how to use this when determining a house investment value. So do me a favor, get another float and desire worksheet, a blank float and desire worksheet. Tear one out from the back so you don't have to flip flop back and forth, you know, if you got it stapled together. So get an investment property worksheet, and then look at page 6 again, page 6. And let's look at case study number 4. So at the top of the worksheet, put case study number 4. All right, you with me? Page 6, case study number 4. Let's read it. You're considering the purchase of a rental house that generates net operating income of $7,000. Now here's where if this is too small for you, you could say $70,000. If it's too big, I mean, get the idea. Don't argue with me on the amounts. Just get the idea. All right, $7,000 net operating income. Your banker says the available financing will require 20% down, 9% interest amortized over 20 years. If you desire 10% cash on cash, what price would you pay? So that's my first question. What price would you pay? Now, then there's a bullet point. What if the market was such that buyers were happy to merely break even, meaning 0 cash flow? Have there been times in our real estate careers when the market was so strong, this might be one of them, that people are willing to buy a rental house just to break even because they know the other benefits and the potential appreciation will outweigh the lack of cash flow. All right, so that's the second question. Then the third question bullet is, what if the market was so strong the buyers were willing to buy with a negative cash flow of $2,000? Have you known markets where it's such a seller's market that buyers are willing to buy with a negative $2,000 cash flow on a rental house just to get the other benefits? So I've got 3 questions for you. I want you to use the float and desire worksheet to tell me what is the investment value of that house to get 10% cash on cash. Then I want you to say, what's the investment value for me to just break even? And then I want you to tell me, how about the investment value if I'm willing to have a negative cash flow of $2,000? All right, go ahead and do it. Chat in your answer now as you go. Chat it in. Do the first one for sure. Do the worksheet and do the double check. I want you to do the double check. Say your calculator on 7 decimals if it'll do it. Or the more decimals, the better. All right, you can do it. I know you can do it. What are we trying to figure out here now? We're trying to figure out this house's investment value. I want to know what price can I pay for this house and get my 10% cash on cash. So I'm looking for a price. When in doubt, follow the worksheet. That'll lead you right through. And then do the double check. Make sure your duckies and piggies are lined up. Sarah, finish it up now. You're 1st and 10 on the 5-yard line again. Punch it across. Get the touchdown. Yep, now double check your answer. Good, very good. When in doubt, follow the worksheet. The worksheet will guide you through. Chat in your answer when you get an answer, please. Chat in your answer. Please chat it in. When you get the investment value, chat it in. Yes, yeah, Brenda, loan to value is 80%, right? The down payment is 20%, so the loan to value would be 80%. That's it, Stacy. That's perfect. Jen, double check. You're real close, but it's just now. How many decimals are you going, Jen? Yeah, that's it, Mike. That's good. Break even now. All right, Jen, double check your numbers a little bit. Now, Mike, see if you can do the negative cash flow. Oh, yeah, $3 is nothing. That's rounding. Yeah. Yep, that's it, Sarah. Now try the bullets. Try it for breaking even and try it for the negative cash flow. Do the double check now, everybody. But chat in your investment value first before you double check. Yeah, Mike, that's it. Well done. That's it, Matt. Now do the double check, Matt. Eric, that's to break even, right? So that'll break you even, Mike. Now do it, or Eric. I mean, now do it with the negative cash flow, $2,000. The market's so strong. I'm willing to have a negative cash flow, $2,000, because the other benefits will more than compensate me. Let's say, and that we might be in that kind of market right now. Brenda, I'm not sure what that is. No, double check that number, Brenda. Now, everybody, it's hard to see sometimes on the worksheet when you make the copies. Step number 4 is take the net operating income and divide by the cap rate. That's a divide sign. Daniel, that's good. That's it. Steve, excellent. Did you do the double check? Double check. Make sure your duckies and piggies are, just prove to yourself that your duckies and piggies are lined up. Roz, double check that number now. Yeah, Brenda, that's it. and do your duckies and piggies. Ross, some double check that number now. That's it, Steve. Good. Good. Now I'm willing to have a negative cash flow 2,000. Now how much could I pay? Yeah, cash on cash is 0. Sarah, yes, yes to what you just said, the last sentence you just said. If he's breaking even, if I'm breaking even, the cash on cash, the buyer's return, step 2 is 0. So all you got to do is satisfy the lender. Alicia, I'm not sure what that is now, what that number is. Take it, you can take a peek at the answer. I've got the answer on the screen. Now, don't just copy the answer, but be careful. And be careful of your decimals. Remember, 0.02 is different than 0.2. 10 times. Stacy, no. No, I'm not sure. That's the same number Alicia got. I'm not sure where that comes from. If you're just breaking even, all you have to do is satisfy the lender. So I think you might be shortcutting it. Just, you know. So all you have to do is satisfy the lender. So just use the lender's return. Step 4 would be 7,000 divided by the lender's return, because the buyer's return is 0. Okay, Russ, good. Did it come out? Are you getting what I'm getting on the screen? And do the double check, everybody. I want you to get used to doing the double check, because the worksheet will stop you. If it's not right, it'll say, whoa, 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 wait, wait, something's wrong. That's it. Now you're talking, Sarah. Now you're talking. That's it. Again, I say to you, think how you would explain this to people. What are you getting with a negative cash flow? Several of you are right on it with the break even. What about I'm willing to buy with a negative 2,000 cash flow? Now, what's the investment value? Think about the negative cash flow. It's so easy, it's tricky. It's so easy, it's tricky. Think about what's happening. If I buy this property with a negative 2,000 cash flow, it's easier than you're making it. Right? If I buy it with a negative cash flow of 2,000, we've got 7,000 net operating income to make the payments. Plus we have 2,000 of my own money. That's it, Eric. What you got right there is good. Right? The property produces 7,000 to keep afloat the loan, and I'm willing to add 2,000 to keep afloat the loan. Therefore, what's our investment value? Stacy, it's the opposite of that. You add 2,000 to the net operating income. Remember, I have negative cash flow. I'm paying out $2,000. Right? So we have how much money to satisfy the lender if I have negative cash flow? We've got 7,000 from the property, and we've got 2,000 of my own money. Yeah, there you go, Stacy. That's it. That's it. Beautiful. That's it, Sarah. That's it. So you got 9,000 divided by the lender's return. Yes. Take another minute or two, and then I want to go through it. And try this on a real property in your town. You know, say, okay, I want X% cash on cash. See what financing is available. See what it'll rent for. Can we try it together? Yeah, you did. The chat looks good. You're doing great. You just got to think about it a little bit. But how many of you can see a use for this? Tell me if you can see. This is not just, I hope I'm not just wasting your time with numbers flying all over the place. How many of you can really use this in the marketplace, or can think of a human being who would be interested in this, a customer, a client? If you can get out there and show people this, I think you'll see a great benefit to it. So tell me, does it make sense? Can you see a use? Yes or no? I'm lonesome. It's just me and the owl sitting here. That's it, Mike. All right, I got at least one of us is in sync, Mike. So good to hear from you, Sarah. Good. All right. So did you do the worksheet now? You got 65,806 is the answer. What is the 65,806? It's the investment value of that house. Investment value of that house. Might the home owner value be something completely different? Might it be appraised for a homeowner at 75,000? Doesn't matter a bit to an investor. An investor doesn't give a darn what the appraised value is. The investment value, in this case, 65,806. If Maggie buys this for 65,806, she'd be able to put the 20% down, get her 10% cash on cash, and keep afloat the loan. Everything's in perfect balance. Takes into account income, expenses, and financing. So that's great. That's terrific. Now, the second bullet, or the first bullet point was, what if you just wanted to break even, or we're willing to just break even? Then all we have to do is satisfy the lender. So it's an easy calculation. We take the net operating income, 7,000, and we divide by the lender's return. Step one there, which is 0.086. If you do that, did you get 81,000? All right. Then the second bullet is, what if buyers are willing to buy with a negative cash flow of $2,000? Well, now what do? We now all we do is take the $7,000 net operating income plus the $2,000 of my negative cash flow. So I now have 9,000 to satisfy the lender. If you take 9,000 and divide by the 0.086, you'll get 104,000. 104,000. So look at this. We've got 65,806, we've got 81,043, and we've got 104,000. Which is the right answer? All three are the right answer to three different questions. What is the 65,806? That's the investment value of that house to break even. And no, that's the investment value of that house to get 10% cash on cash. What's the 81,000? That's the investment value of that house to break even. What's the 104,000? That's the investment value if you're willing to have a negative cash flow of $2,000. All right. How important is it to have accurate income? Accurate net operating income, really important. So you've got to get out into the market to know what a house will rent for. I'm in Scottsdale, Arizona a lot, and I happen to know that market really well. And I one time went into an open house in Scottsdale. We have open houses during the week, during the winter, because a lot of snowbirds. And I went into an open house that a nice realtor was holding open. She was real nice. And it was in a market that I happen to own some rental houses in that area. So I know what the house would rent for. So I'm walking through the house and I said to her, do you happen to know what this house would rent for? And she said $1,900 a month, $1,900 a month. Now I knew that was wrong, but I didn't want to say anything. I didn't want to get an argument, but I said to her, now, can I just ask you, how do you know that? And she said, well, that's the owner's house payment. Now you tell me, what does the owner's house payment have to do with what the property will rent for? Nothing. So you need to know the market value of the rent. The other thing I want to say is, what if I said 65,806? And I told you 65,806 is the investment value of that house to get your 10% cash on cash. And you say, how did you do that? And I say, well, I took your $7,000 net operating income and I divided by the cap rate to get 65,806. You would think to yourself, well, what do I need you for? I can divide. I don't need anybody help dividing. So see, us financial guys never use the word divide. What do we say? Instead of divide, what do we say? Here's what they say. I took your 7,000 net operating income and I capitalized it. I capitalized it and got 65,806. And you think, oh, okay, all right, capitalize. I need help with that. What does capitalize mean? It means divide. It just means divide. I think if you can do this, you know your stuff. Now, those of you, some of you I know would like to practice this. All right. And I don't mean for GRI, I mean for real life. Can I just show you in your book? You've got a couple extra case studies. Look at page 7. There's a case study on a 30-unit apartment building. And I've got the answer up on top. That's your answer, 618, 361. Look at the next page. That's a little fourplex, and I've got the answer up there. And then on page 10, there's a developer developing a piece of raw ground, what they can afford to pay for the land. And it turns out to be $1,311,000. So I've got the answers for you, just if you want to practice. You don't have to do that, but I know some of you, I just know from phone calls I get, people like to practice this and really nail it down. So we're going to have lunch now. You all did great. And it's a little after noon. How about 1:15 again, like yesterday? An honest 1:15. And this afternoon now, we're going to talk about return on equity and doing a 1031 exchange, how all that works. So, all right, that's it. Well done, everybody. If you have questions, chat them in. I'm glad to help. Otherwise, I'll see you at 1:15.
Bye.
That sounded like a chicken. 4 minutes to showtime, everybody. 4 minutes.
Oh, there we go. We got our chickens moved, Tom.
Did you? All right, good.
Yep. My son brought his lasso and we lassoed them babies up and threw them in the swimming pool.
Well, I'd like to watch that. That's pretty funny.
The grandkids have no place to swim now, but it's okay.
That's very funny. All right, here we go, everybody. Hope you had a good lunch. Back for more, rounding third, heading for home here. And I heard from a couple of you over the lunch hour. That's great. I'm real glad you're interested in this stuff. I want that to be so. And this afternoon now we're going to talk about exchanging. And people get real. This is such a great opportunity, and people think how difficult it is. It's not difficult. We're going to break it into bite-sized pieces. And I think what you'll find, we're going to break it into 8 pieces, 8 steps to a successful exchange. The title is When, Why, and How to Do a 1031 Exchange. And would you do me a favor now? Separate the exchange portion of your handouts. Otherwise, it just gets too confusing. It'll say part 4, when, why, and how to complete a 1031 exchange. And there are, in that section, there are 10 pages. Just separate those pages from all your other junk or all your other stuff, all your other pages. I think that'll be worthwhile. Here's the old Chicago Cubs. This is my first exchange. My first exchange, what was exchanged was me. I got traded from the Chicago Cubs to the Minnesota Twins, even up for a guy named Mike Adams in a trade that rocked the baseball world. Nobody ever heard either one of us. But these are the ones you read in the newspaper in the tiny, tiny print, you know, on the last page of the sports page, that transaction section. And you think, well, who cares about that? Well, his mother cares, if nobody else. So I played for the Cubs and then got traded in 1975 to the Minnesota Twins and played there. And then got into the real estate business, started investing in real estate when I was playing baseball. But exchanging, really, when you exchange players, the accounting is very much like the accounting we do when you exchange rental property. So let's summarize now. We've been together for a day and a half here, and you think, well, what have we learned? We've done the investment property worksheet. Remember, 3 parts of the machine and the income, expenses, and financing. And then we figured the cash flow, the principal reduction, the tax savings, and the appreciation, potential appreciation. So you all did that. You know how to do depreciation. You know how to be a bifurcating specialist. You know how to correct if you've made a mistake of not being a bifurcating specialist. Form 3115, it might be useful with your accountant. And the investment property worksheet, we talked about float and desire worksheet, how to put a value on a rental property, an investment value on a rental property. We talked about the difference between a property's homeowner value and the investment value. Those are 2 different things, so that's good. And back to the good old investment property worksheet. You know, this plain old worksheet is our friend. And over and over and over again, you'll use this worksheet. And you would do this worksheet when? Before you buy the property. Yeah. You'd use it before you list the property. Yeah. And then when else would you do this worksheet? Remember, every year on the anniversary date of your purchase, you redo the worksheet and you figure your rate of return on your what? Not on your investment, on your current equity. Return on equity. Those of you who own rental property, you should know right now, if I asked you, you should know what is your current rate of return on equity. And the problem is, the longer you own a property, what happens to that return on equity? Typically, what happens to that return? It goes down, right? The longer you own a property, typically your return on your equity falls. And so what we do is every year we figure how much equity we have, and then figure the return on that equity if we would keep the property another year. And then we compare that return on equity to what we could do with that same amount of equity investing in a different property. And if we can do significantly better, it's time to move that equity. And we'll talk about moving your equity. And so that's where an exchange comes in. And I think the best way to do this is with an example. So I'm going to take you through a complete exchange process here. Take a look at the part 4 booklet. Part 4 booklet, and turn to page 4. Page 4. And you see it says 8-step exchange process. There are 8 steps, step 1, 2, 3, all the way to 8. And if you just kind of follow this roadmap, I think it'll make complete sense to you. So do me a favor, take page 4 and tear it out of your book and keep it right next to you. Keep it right by your side, because we'll be referencing this throughout the afternoon. We're going to go step 1, step 2, step 3, and so on. Okay, so set that aside so that we can look at it. And then turn to page 5. Let's just jump right into the deep end of the pool here. Turn to page 5. And we'll start with case study number 1. And it says case study number 1. We're going to continue this case study through the whole afternoon, each part. Case study number 1. Let's read this together now. Everybody with me? Case study number 1 on page 5. At your 20th high school reunion, you reconnect with an old friend named Scott. You tell him that you're in the real estate business, and he says, "Hey, that's great. I've been doing some investing myself. You agree to get together next week and talk shop." A week later, Scott tells you about a property he bought several years ago for a cost of $175,000, $30,000 out of his pocket, and the rest by obtaining a $145,000 loan. Scott says the property is a terrific investment. It's appreciated and today's value is 310,000. So look at this. He bought it years ago for 175,000. It's worth 310,000 now. Is that possible? Yeah. Yeah. Scott's worked hard and he's paid his mortgage down to a current balance of 95,000. So his $145,000 mortgage is now paid down to 190 or to 95. You tell Scott that you recently attended a seminar where the concept of return on equity was discussed. Just for practice, you ask if you can get some information and help Scott calculate his current rate of return on equity. And here's what you learn. The market value of the property is 310,000. The current loans are 95,000 at 4.75, 600 a month. There's your annual rent, your vacancy, your operating expenses, your interest. Scott's in a 30% tax bracket. His depreciation would be 11,000 and his selling expenses, if he were to sell, total 8%. All right. So if you look at your 8-step process, look at step 1, calculate the net equity after the selling expenses for property A. Scott, we'll call this property A. All right. So do me a favor and look right down there on page 5. Look at step 1 underneath selling expenses. I want you to take some time right now and figure for me Scott's net equity and just follow a sale price minus cost of sale minus the loan. What is his net equity? Go ahead and do it. Go ahead and do it. Let's pretend I'm Scott. So tell me my net equity. Chat it in when you get there. When you get the answer, chat it in. So again, that just helps me know how fast or slow to go. Okay, that's it, Mike. What's his net equity? Just follow the little formula I've got there for you. No hard math. Let your calculator do the math. Yeah, Kurt, that's it. That's it. Chat it in, please. Chat it in. Just take the information right from the case study, right from the information above there. That's it, Jen. Alicia, good. Good. Chat it in, everybody, and make sure you know where the numbers come from. I want you to get the numbers, Steve, that's good. But also know what they are and how to explain it to people. Sarah, that's it. Check the screen. I've got the answer up on the screen. That's it, Julie. Right? Wouldn't it be this? If I'm Scott, so let's say I'm Scott and I've got a 310, it's worth $310,000. I'd have to pay 8% in all manner of sales costs, brokerage fees, closing costs, attorney fees, accounting fees, everything. And that's $24,800. And I'd have to pay off my mortgage of $95,000. Couldn't I, if I sell this property, couldn't I walk out of that closing with a check in my pocket for $190,200? Yay or nay? Yay, $190,200. That's my net equity. I could sell it and walk out of the closing with a check in my pocket. All right, how much money do I have invested in this property today? How much money? What does it say? How much money do I have invested in this property today? How much money do I think I have invested in this property today if I'm Scott? What I think I have, and here's the mistake that people make, what I think I have is, in this case, $30,000, right? Because look up at the second paragraph. It says that Scott bought the property for a cost of $175,000 with $30,000 out of pocket and the rest by obtaining a $145,000 mortgage loan. So I think I'm a genius. Look at this. Look at what I've got, my return on my $30,000 that I've got invested in this property. That is faulty thinking. The fact that I put $30,000 cash into this property several years ago has nothing to do with today. You're taking a picture of me today. Today, I've got $190,200 invested in this property. right? That's a big hurdle you got to get people over, including I know some of you because I've talked with you. I think I've got 30,000. No, the question is, what should we do today with the $190,200? So I'm Scott, and I think this investment, this is a fantastic property, man. I'm just keeping this property. It couldn't get any better. And you say, well, Scott, do you mind if I take some time and figure the rate of return on your net equity if you keep the property another year? Because the decision we'll make will be, okay, here I am today. I've got $190,000, $190,200. If I keep the property, what am I doing with my $190,200? Not nothing. That's what people say. Well, nothing. No, not nothing. You're rebuying the property. Rebuying, I say in quotes. Every year that you keep a property, you are rebuying it with your equity, your net equity as the investment. You're saying, all right, let that $190,200 ride on that good deal. And so the question becomes, if I let it ride on that good deal, if I keep the property, I'm rebuying it, what would my rate of return be on my $190,200? All right, so look at the 8-step exchange process. Look at step 2. Use the investment property worksheet to calculate the current rate of return on equity for property A. So what we want to do is figure Scott's return on equity if he keeps the property another year. Make sense? So get another investment property worksheet. To get it from the back of your book, get an investment property worksheet. Okay. And where it says purchase cost, you can leave that blank. He already owns the property. Where it says cash invested, scratch the words cash invested and replace them with net equity. And what number goes on that line? $190,200. $190,200. That's what he's got invested in this property. That's the big hurdle you got to get people over, because they're going to get mad at you. I've had people get mad at me when I say you've got $190,200. No, I don't. I got 30,000 invested. No, you don't. You've got 190,000 invested. All right. So then, would you do me a favor and, taking what you've learned in the last day and a half, would you complete the worksheet for Scott and figure his rate of return on his current equity? So go all the way down, work it down through, and chat in your answers, chat in your cash flow, chat in your principal, chat in everything as you go. Please, please, please. That helps me. And then we're going to see what we can do with his $190,200. All right, go ahead and do it. Round off to the nearest dollar now. You're figuring step number 2 is use the investment property worksheet to calculate the current rate of return on equity for property A. You're doing this for your pal Scott. Go ahead and do it. You can do it. Chat in your answers, please. And think how you would explain it to people again. This is exactly, do you remember I told you yesterday about Matt in St. Louis? The young guy who, his first client, he did 42 properties exchange. He is exactly what he showed him. This is exactly how we did it. I coached him a little bit. All right. When in doubt, follow the worksheet now. You should have all the information. Yeah, Eric, that's it. That's it. That's your cash flow, right? I've got the interest in there. I've got all the information, so you don't have to do too many calculations. Just follow the worksheet and think how you would explain this to your friend Scott. Sarah, that's your cash flow. Good. Good, Eric, that's your principal reduction. Very good. Chat it in, everybody. Please chat in your cash flow. When you get your cash flow, chat it into me. Mike, I think that's a little high. Be careful whether you're saving or paying tax. Be real heads up, paying or saving tax. That's it, Sarah. That's it, April. Take your time and really understand it. This is why you could do this with a spreadsheet, but the problem is, where do the numbers come from? We got to be able to explain these numbers. Alicia, double check that number now. Double check that one. That's something's wrong there. Mike, there you go. Matt, there you go. That's it, April. Yep, it's easy to make a mistake. That's why I want you to go slow and steady and just be, until you really, really, really get used to this worksheet. That's it, Jen. So again, think how you'd explain this to your old high school buddy. Good, Daniel, that's your cash flow. So keep going. Nathan, that's it. Well done. So think what you would say to him. That's it, Steve. Sarah, that's your tax saved. Brenda, that's your principal reduction. Good. That's it, Alicia. April, that's your tax saved, right? Good, Sarah. Daniel, I don't know what that number is. That one, I'm not sure what that is. You got 5,600 for cash flow. And then are you working on the principal reduction, Daniel? Yeah, double check. So your debt service, remember your debt service is $600 a month. That's 7,200. And then I'm giving you the interest in the case study. The interest is in the case study. Yeah, April, carry it out another couple decimals if you can do it. It should be 4.8%, but your calculator is rounding to 5, so that, that's fine. Brenda, you're not going to save that much tax. That's the taxable income. You're going to save 30% of that. You're in a 30% tax bracket, right? You're not in 100% tax. You're not paying 100% of your income yet. 30%. That's it, Alicia. That's it, Daniel. 2747, Daniel. 47. That's it. So now what do you tell the IRS? Yeah, Brenda, that's your tax saved, right? Roz, that's it. Perfect. Beautiful. No, you don't have to pay, do you? You figure your taxable income. Do Roman numeral 3. Roman numeral 3. You're still saving tax. Yeah, Eric, you might be a good tenant, but I mean, figure the return on your equity, figure what you could get for that property. Because what you might not be paying yourself rent, but what you're getting is what you could be getting. You know, so absolutely, you do the same analysis. Or maybe you are paying yourself rent. Alicia, it's a little too low. Double check now. Are you saving or paying tax? Be careful whether you're saving or paying tax. Alicia, I wonder if you did it as if you're paying tax. That's it, Brenda. Just take a few more minutes. If you finish before everybody, it's okay. Just relax. Let everybody catch up. I want people to go slow and get it right with confidence. Daniel, it's not quite that much tax savings. Daniel, what'd you get for taxable income? Way to go, Sarah. No, double check your numbers, Dan. You got net operating income minus the interest, minus the depreciation, and the interest and depreciation are given in the problem. So, you know, literally fill in the spaces on the worksheet. Let the worksheet do the work. Sarah, that's good. I think you mean that's good, right? Take a couple more minutes and I want to go through it with you. Daniel, don't start with the net operating income, 12,800, and then subtract the interest and the depreciation to get your taxable income. Yeah, there's really no cap rate on a property you already own, Brenda, but that's okay. That's right. Yeah, the cash on cash would be legitimate. The cash on cash, you earn 5,600 on a $190,000 investment. That's not so good, is it? Yeah, there you go, Dan. Is it okay if I call you Dan? That's your tax save, Daniel. Yeah, good, perfect. Now roll it up down at the bottom and you'll get a rate of return. There's return on his equity. One more minute, then then I want to go through it. We'll go through it together. And I want to show you, so what? You know, big whoop. What's the big deal here? Well, it is a big deal. So Daniel, what'd you get for the rate of return? If you add up everything on the right-hand column there, and then divide by your equity. Yeah, good, perfect. Perfect, let's try it. Let's try it again. Could this be real world? Here's your friend Scott, you meet him at a reunion, and he tells you he's got a great investment property. You say, oh, okay, can I figure the return on equity for you? Sure, go ahead. He says, I don't know what that is, but go ahead. Well, the first step is you got to figure how much equity he's got. He's got $190,200 net equity. He could sell this property and walk out of the closing with $190,200 in his pocket. Therefore, how much does he have invested today? $190,200. It does not matter what he did years ago when he bought the property. You're not analyzing what he did years ago. You're analyzing today. All right. So he's got, let's fill in the blanks. He's got a $95,000 loan at 4.75, $600 a month. That's $7,200 in debt service. And then the property rents for $24,000. Let's take 10% of that out of there. He's left with $21,600, and his operating expenses total $8,800. Now, you wouldn't believe this necessarily with all these zeros here, but believe it in here just to get the idea. But you would want to verify all this with his Schedule E. All right, so you'd say, Daniel, let's figure your cash flow. You start with the gross operating income, which is $21,600. Minus the operating expenses, $8,800, you get $12,800 net operating income. $12,800 net operating income. The net operating income is the amount of money he'd have in his pocket if he owned it free and clear, but he doesn't own it free and clear. He's got to pay his mortgage. So he's got to pay $7,200, $600 a month. $7,200, he's left with $5,600 in cash flow. He says, you say, Dan, Scott, you've got $5,600 in cash flow. He said, I knew it. I knew this is a great investment. $5,600 on a $30,000 investment. Try to beat that. Faulty thinking. It's $5,600 on a $190,000 investment. And you go, oh, all right. Well, that's benefit number one. The second benefit is principal reduction. The debt service is $7,200. The interest is $4,453. The difference is $2,747. So not only does he get $5,600 in cash flow, the tenants pay his loan down $2,747 for him. All right. Now, what does he tell the IRS? The IRS says, okay, how'd you do on this property? Daniel says, well, my net operating income is $12,800. From that, I get to deduct the interest, $4,453. You cannot deduct the principal. All right. The interest, $4,453, minus the depreciation, which we say in this case is $11,000. Now, do you need to know if, when, or how he bifurcated when he bought the property? No. Where would you get the information about the depreciation? Right off his Schedule E. Right on his Schedule E. It says right there. All right, so $11,000. And now if you make this calculation, net operating income minus the interest minus the depreciation, you end up with a taxable income negative $2,653. Scott's taxable income would be negative $2,653. Did he really lose $2,653? No. He just gets to say he lost $2,653. What created that loss? Depreciation. All right. So now that loss can be used to shelter other income in a 30%. It's subject to the passive loss rules. 26. So you're always going to be able to use the loss. It's just a question of when. For most people, they can use it right now this year. Let's assume Scott can use that loss. That'll save him not $2,653. It saves him the tax on $2,653. If he's in a 30% tax bracket, 30% of that is $796. Income tax saved. That's cash money. If he does not buy this property, what happens to that $796? He pays it to the IRS, and they want it in cash. The appreciation, zero. You'd say, Scott, zero appreciation. What if Scott says, what are you talking about? Zero appreciation. this thing's gone up in value a ton since I bought it years ago. Shouldn't that count for something? You'd say what? You'd say it sure should, and it's already in there. The appreciation up till now is in there. It's in his $190,200 net equity. Remember, his property's worth $310,000 now. So any appreciation up till now is in there. It should be. It's happened. What I'm saying is zero is the appreciation going forward. So down at the bottom, let's figure his return without appreciation. We add up the right-hand column. You add up the 5,600 cash flow. You add up the 2,747 principal reduction. You add up the 796 tax savings. That's 9,143 in his total benefits. What does he have to, what's he invested? What's he got invested to earn 9,143? Not 30,000, he's got 190,000. If you make that calculation, that's 4.8% on his equity. Scott's earning 4.8% on his equity, on his net equity. If he keeps this property another year, he will be earning 4.8%. Now, he is shocked. I know how this works. He's shocked. Some of you who've owned property a long time, run the return on equity on your own property and see what happens. You'll be shocked. You're going to shock yourself. Be sure you're sitting down when you do it. Some of you might own a rental property free and clear. You might be lying down when you do that one, just to be sure you don't hurt yourself. 4.8%. Now, what if he said, "Yeah, this is I can't believe this." That's what they'll say. But you know what? I need that cash flow, that 5,600. You don't need that cash flow. You need good cash flow. You need tax shelter cash flow. This isn't good cash flow. This is 3% of your net equity, plus you're paying tax on half of it. Look at this. Your taxable income, you're not sheltering all of it. And so he said, okay, what if he says, "I'm old"? Well, he's not old, but how many of you know people who've been paying extra on their mortgage to try to get the thing paid off faster? Well, that makes no sense. That's like starting at 15% and then trying to get as fast as you can down to 4%. Well, that's that. So you show him this. You show him this. Now, turn to the next page in your book. Turn to the next page. Page 6. So it's case study number 1, continued. When Scott learns that the rate of return on his 190,200 equity is only 4.8%, he's shocked. He thought the property was a great investment. You see, it might be a great property, but it's not a good investment anymore. Because the longer you own a property, your property gets tired in your hands. It just gets tired. It's tired. And you need to recharge the thing, you see. It's not a bad property, it's just a bad investment. But based on the low return on equity, he tells you he'd like to sell this property and invest his 190,200 in a property that produces a greater rate of return. Is that a reasonable thought on his part? Yeah, you convince him, you show him that he's only earning 4.8% on his 190,000. So he says, all right, I'm selling this property and I'm going to buy another property that makes more money. And you, third paragraph, you explain that's a great idea, but he shouldn't forget about his partner. Scott says, I don't have any partners. And you respond, oh, yes, you do, the IRS. You see, if you sell your property, remember yesterday we talked about the bus coming back at you and your gain and all that stuff. Well, here it is. Here it is. He's got a partner, the IRS. If Scott sells his property, he'll have to pay tax. And in order to pay the tax, remember, you need to know the adjusted basis and the gain. So step 3, look at step 3 in our 8-step process. Calculate the gain and tax if property A is sold. And so would you take the information, there's his selling price, 310. He's got 8% cost of sale. Let's say his adjusted basis, 130,000. I'm not going to require you to figure the adjusted basis. I'll give it to you. And the gain will be taxed at 25%. Complete step 3 there at the bottom of page 6. Tell me his tax. What's the tax? Go ahead and do it. You can do it. Chat in your answer when you get there. Yeah, that's it, Jason. That's it, Sarah. No hard math. Now just follow that little roadmap. That's it. You're all getting it. Wouldn't it be this? He could sell the property for 310,000. He'd have to pay cost of sale 24,800. He'd have to his adjusted basis is 130,000. So you get to subtract that. He's got a gain of $155,200. $155,200 is his gain. Is that gain taxable? Yeah, if he sells, it's taxable. State and federal, on average, you got recapture, you got capital gain, you got say 25%. 25% of that is $38,800 in tax. He's got to pay $38,800 in tax. All right, you with me? All right, so now you show this to Scott and you think, oh man, 38,800. Turn to the next page. Page 7. So Scott, instead of having $190,200 of net equity, I want you to figure, please, his after-tax equity. So step 4 in our 8-step process, look what it says. Subtract the tax from the net equity to arrive at after-tax equity if property A is sold, underlining sold. Go ahead and do it. Just fill in the blanks. Fill in the blanks. If I'm Scott, what's my after-tax equity? Easy math. It's easy math now. That's it, Sarah. That's it, Stacy. Think how you would explain it now, too. Also, all these numbers. I want you to get the numbers. Yes, yes. But I care even more that you can explain it. Chat in your answer now. If I'm Scott, what's my after-tax equity? That's it, Roz. Stacy, that's it. No hard math. Just put it into the little roadmap I've got there on page 7 for you. This is if he sells. Right? The question is, what's the tax if he sells? And what's his after-tax equity? Right? Wouldn't it be this? Wouldn't it be this? No hard math. Now look at he's sale price 310,000. Cost of sale, he's got to pay 24,800. He's got to pay off his mortgage of 95,000, and so his net equity was 190,200. But then he has to pay the IRS $38,800. So his after-tax equity is 151,400. So look at page 7, the middle of page 7. If Scott sells, underline sells, he doesn't have 190,200 to work with. He's after paying his tax, he's only got $151,400 to work with. Right, you with me? Dan, take a look at what I've got on the screen now. Take a look, double check your numbers. That one's a little too low. Double check. Okay, so $151,400. If I'm Scott, if that's what I have to pay, that's what I have available if I have to pay the tax. All right, and I'm going to have to pay the tax if I sell this property. All right, so that was step 4. Now let's look at step 5. Use the investment property worksheet to calculate the 4 benefits and rate of return for property B. So here is Scott. He realizes he's only earning 4.8% on his equity. So he's looking around and he finds property B. We need to figure the return on property B. And if it's better than 4.8, what should we do? Move that equity. The problem is if we sell the property to move the equity, we got to pay $38,000 in tax. So look at page 8. Case study number 1 continued. Your company just listed a small apartment building, property B, that can be purchased as follows. $540,000 is the purchase cost. Going to get a new loan of $355,000, and we need $185,000 cash invested. That's $10,000 closing costs and $175,000 down payment. Right? Could that be possible? So if I'm Scott, I need $185,000 to buy this property. Now, the only reason I'd buy this property B is if the return is better than property A. So look what it says. Step 5, you complete an investment property worksheet for property B and calculate the following. So I'm not asking you to complete the worksheet, but here's what you found. Here's the right-hand column. There's your cash flow, your principal reduction, your tax savings, and the appreciation. And so I want you to tell me what's the rate of return on property B if you invest $185,000. So add up your benefits and divide by the $185,000, and you tell me what's the investment, what's your rate of return. Go ahead and do it. Chat in your answer. That's it, Jen. Yep, no hard math, Eric. That's it. Good. Yep. Good. Everybody good. You're getting there. You're nailing it. That's perfect. Daniel, that's it. Are you getting what I'm getting on the screen, right? If you add up the cash flow that you calculated, you add up the principal reduction and the tax savings. That adds up to $25,900 in net benefits. Now, how would you really do this? I'm streamlining here. You would do the investment property worksheet for property B, but let's assume you've already done that. And you calculated the cash flow to be $17,500 and the principal to be $6,000 and the tax savings to be $2,400. If you add that up, that's $25,900 in benefits. What would you invest? $185,000. That's 14%. 14%. Right? You with me? Okay. So now let's keep going. I'm on page 8. So property B produces a 14% rate of return. So next paragraph, you're thinking, You wonder if Scott could sell building A and use his $190,200 equity to buy building B and triple his rate of return. Look, he'd be going from 4.8% to 14%. Come on, it's 3 times. And he's got $190,200 and all he needs is $185,000 to buy property B. So it works. Wait a minute. What about tax? If he sells, he'll have to pay tax in the amount of $38,800. So he'd only have $151,400 to invest. And property B requires $185,000 cash. But could it work if he didn't have to pay those pesky taxes of $38,800? Yeah, Then it would work, wouldn't it? If he didn't have to pay the tax, then he'd have $190,000. He'd have plenty of money to put down to invest $185,000. So if he didn't have to pay the tax, he could do it. What's the solution? Exchange, exchange. And so we need to talk about, remember we're talking about if, when, why, and how to do a real estate exchange. We've talked about maybe when, we've talked about why to increase your rate of return. Now let's talk about how. Turn in your book, please, to page 9. Turn to the next page. And let's talk about exchanging. Exchanging is one of the most misunderstood things in the real estate business. It's also one of the most powerful things in the real estate business. But again, we've got to be able to explain it to people. And so I want to show you how to explain an exchange. And then we're going to put the numbers to it. But the real skill comes in being able to explain this stuff to people. Now, when I say the word exchange, what do people think of? What they think of is trading properties, where you literally trade property A for property B. I've been doing exchanges for 45 years. I have never seen a 1-for-1 exchange that made sense. Never once. And the good news is there is no exchange in an exchange. It really should be called continuing. If they called it real estate continuing, far more people would understand it and far more people would do it. So where it says exchanging, I'm filling some blanks now on page 9. Exchanging is really not a good description of the process. It should really be called continuing. Write the word continuing there. You never have a gain unless you sell. You never have to pay tax unless you sell. Well, the idea behind an exchange is you're really not selling, you're merely continuing your investment. And the IRS says, well, okay, if you merely continue your investment, then we'll let you pack up your gain from property A and carry it over to property B without paying tax. So in order to qualify for this, though, we have to meet some rules. And I want to talk about those rules, but let's not start now. Let's take our break. Let's take a break, because otherwise I'm going to have to quit in the middle. Let's take a good break now. It's 5 after 2. We're just going to take 2 breaks this afternoon. So how about this? Let's take a 13-minute break. Take a 13-minute break. Get up and walk around a little bit. Do some jumping jacks. Do a cartwheel. I'm going to go do cartwheels out on the driveway. 13 minutes. Chat in
Video
your
that,
entry.
would you, Tom?
What? Put it on.
I want to see you do a cartwheel.
Yeah, you'll feel the earth shake when I do it. So don't worry. Kurt, here it is. Here's the bottom of page 8. Well, I thought I had, hang on. I'm not, is this the, here, my question is this what you're asking about? There you go. Is it the 25,900, Kurt? Is that what you're asking? All you're doing is adding up your benefits from on page 8, the middle of page 8. Kurt, are you there? You're out doing cartwheels on the driveway, aren't you? See if that answers your question. I'm just not sure. 1 minute warning. We'll go to work in 1 minute, everybody. I sprained my ankle doing cartwheels.
So if you're to prioritize which of the measurements is most meaningful or how you should step back and, what's this all mean? I mean, you got return on equity. I've got, I got my return on cash invested. I got my cap rate. I've got my, multipliers, blah, 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 blah. So, I mean, you start comparing properties.
Cash on cash and cap rate, that would be determining today's value. That's the price you're paying.
Right.
Return on equity is the decision of whether to keep the property or move your equity.
So isn't it best to consider everything off what things are worth today? Because that's what's real. I mean, it doesn't matter if I had it for 10 years and I paid $100,000 less. I mean, my return on equity is going to be less unless I've, refinanced it along the way type of thing. It's still going to get down to, what's the return on, are there other alternatives that can return better than what I currently own, right?
Right. That's what we're doing, right? You've got to.
Yeah, exactly. So
If
it's
you're
just,
Scott, if you keep this property, your 190,000 is invested at 4.8. If we move it, you're going to invest it at 14.
that's kind of like a no-brainer.
Yeah, right. Yeah.
As long as you can find the 14. I mean,
well, yeah, but see, that's why every year you figure your return on your equity and look around to see if you can do any better. If you cannot do any better, keep the property with confidence, knowing you can't do any better.
Yeah.
Yep. It's the decision of whether to keep the property or move your equity. And there might be several times when you cannot do any better. Then keep it. Make sense?
Yeah.
Good.
But then the threshold for when somebody wants to take a decision to buy or not buy, I mean, everybody's got a different bar they're trying to get over, whether it be, hey, I need to return 10% of my money or 5 or whatever. It's going to be.
Well, I mean, I think everybody, what people are interested in is money.
Yeah.
Which will return them. I don't care if you call it cap rate or cash on cash. I want to know how big a pile of money will I have? And that's what all this goes to. The neat little worksheet, do that worksheet when you're analyzing a property, and you'll have people say, all right, I need this much cash flow, or I'm in it for tax savings, or I'm in it for principal reduction. I don't know anybody in it for principal reduction, but cash flow is most important to me. Well, do you want it tax sheltered, or are you going to pay tax on it? So all these things, there's no right answer. I agree with you. There's no right answer, but our job is to translate it into a system that people can understand. I think if you can do that, you'll deal with a variety of clients and a lot of people who have a lot of money who are looking for a guy like you. And that's the honest truth. All right, let's go back to work, everybody. Got to go back to work now. So I'm glad you're interested. I think it's terrific. So look what we've done so far now this afternoon. You met your friend Scott at your high school reunion, and Scott had a property he's owned a long time, and he thought it was a great investment because he only put $30,000 down years ago. And you explained to him that, well, that doesn't make much sense because we got to figure what your position is right now. Well, right now, you figured he has $190,200 invested in that property. And you figured if he keeps the property another year, his rate of return on the $190,200 will be 4.8%. And you point that out to him and he goes, oh, that doesn't sound very good. And he said, I want to sell this property then. If I'm only earning 4.8%, I want to sell this one and go buy a different one. And you say, well, what about your partner? And he says, I don't have a partner. And you say, yes, you do. It's the IRS. And so what we did is we figured how much tax he would have to pay if he sold, keyword sold. And we figured that was $38,800. So then you explain to him, you've got $190,200 equity, net equity, but if you sell, you've got to pay $38,000 in tax. So you really only have $151,000, I'm rounding, $151,000 in after-tax equity to buy a property, to invest in another property if you pay the tax. Paying the tax is a giant step backwards, right? And he thinks, oh, well, that's not so great. And then you find a really good property B, that produces, if for the owner, would produce a 14% rate of return. Remember, Scott's only earning 4.8%, and you find property B and it's 14%. and property B only needs 185,000 cash to invest in, to purchase cash, and then you're going to borrow the rest. And you think, well, Scott, come on, he's got 190,200 equity. He could use 185,000 of that and buy property B. No, he couldn't. No, he couldn't if he sells property A and buys property B, because he'd have to pay this darn $38,800 in tax. Now, if he didn't have to pay the tax, then it would work. Then it would work. He could dispose of property A and acquire property B, and without having to pay the tax, it would work. So the question is, how can you do this without paying the tax? And that's what an exchange allows you to do. So let's talk about exchanging, and let's talk about how to explain an exchange to people. We got to be able to explain it. So we left off, exchanging is really not a good description of the process. It should really be called continuing. You only have a gain if you sell. If you don't sell, you don't have a gain. You don't have to pay tax if you don't sell. And what the IRS says, well, in an exchange, you're merely continuing your investment. And if you continue your investment, you get to pack up the gain from property A and put it in a little suitcase and carry it with you to property B. And it will sit in the attic of property B for how long? For as long as you own property B. But when you sell property B, eventually, what's taxed? The gain from property A and the gain from property B. But what could you do? You could continue. You could exchange again and carry 2 suitcases to property C, and those gains would sit in the attic. And so you can do this how many times in your life? No limit, no limit. Now here I am in the last rental property of my life. I've never paid any capital gain tax. Why? Capital gain is a voluntary tax. If I sell that last property of my life, what's taxed? All those gains are taxed. But what am I going to do? I'm going to die. And then I got them. Because remember, when you die, what happens to your gains? They die with you. They die with you, never, ever, ever taxed. And this is what people do. They exchange, die. And then when I die, you, my cousin, inherit my last property at its fair market value at the time I died. And it's as if you bought it for that price, and you get to now bifurcate and own the property. And so now people will say to me, whoa, okay, all right, but where do I ever get any money? I'm rich. I just can't afford to buy lunch, people say. I don't have any money. So what do? We exchange, refinance. Exchange, refinance. Exchange, refinance, die. Borrowed money is not taxable. Remember, we said way back yesterday morning, all dollars are not created equal. Well, if you borrow money, it's not taxable. No federal, no state, no Social Security, no nothing. And so there's some young people in this webinar. And well, I saw one. And what if you started this when you're a young person? Could you exchange? And on your 50th birthday, could you go in and borrow $1 million against your equity? Yeah, you just stick it in your pocket. You don't have to pay it. You don't even have to claim it as income. You just stick it. You think, come on, I got to pay the loan back. No, you don't. Your tenants do. And so see, this is what happens. People will exchange, refinance. Exchange, refinance. And then ultimately die. And they'll do that their whole lives. All dollars, it certainly beats having a job. You know, if you think that's difficult, think what people do with having a job. How many people have a difficult job, and those dollars are only 50-cent dollars. And so show this to people. The people who get it really get it. The people who don't get it don't get it. Well, that's okay. Be friendly to everybody. You're not trying to convince everybody, but just present it to your client. And if they go, oh, I don't think so, just shake their hand and say, okay, okay. All right, so continuing. In order to be treated as if you're merely continuing in an exchange, you have to exchange what's called like-kind property for like-kind property. Have you not heard of a like-kind exchange? Yeah, so it has to be like-kind for like-kind. If you exchange like-kind property for like-kind property, the IRS says, okay, you're just continuing your investment. Now, the question is, what's the definition of like-kind property? Could I, if I'm Scott here, I've got this apartment building that if I keep it, I'm earning 4.8%. Could I exchange this apartment building for a bigger apartment building? Would that be like-kind? Yeah, that's like-kind. Could I exchange my apartment building for a shopping center? Could I exchange my apartment building for raw land? Could I exchange my apartment building for the house you live in? The answer to every one of those is yes. Yes, that's all like-kind. You think, how can that be like-kind property? What are you talking about? You got apartment buildings, shopping centers, and raw land, and primary residence. Well, what like-kind property does not mean, it does not mean apartment for apartment or shopping for shopping, as one guy called me last week and said his accountant told him he has to exchange his shopping mall for another shopping mall. That's total baloney. What like-kind property does mean, and what I'd like you to fill in the blanks, now we're on page 9, like-kind property is any property held for investment, put the word investment there, investment or use in a trade or business. It's any property held for investment or use in a trade or business for every other property held for investment or use in a trade or business. So would all those examples I gave, would they fit? Sure. If I exchange apartment building for apartment building, well, that does. What if I exchange my apartment building for a shopping center? Sure, that's investment property. What if I exchange my apartment building for raw land and hold it for investment? Sure, that would work. What if I exchange my apartment building for the house you live in? Would that be an investment for me? Yes. If I use your house as an investment, that would be like-kind for me. It would be the sale of your primary residence for you, right? So like-kind property does not mean, here's the key point out of that. No, a REIT is typically, Jason, you're asking about a REIT. Typically, that's not owning any real estate, right? A real estate investment trust typically is not owning, you don't own any real estate, you own shares in a REIT, probably. So it's not going to be like-kind, probably. Okay. So investment, use for investment or use in a trade or business. So if all you receive is like-kind property, the IRS says, great, pack up your gain and carry it with you to the next property. So if there's such a thing as like-kind property, there must be such a thing as unlike property. Yeah, and you don't want to get any of this. And there are 3 types of unlike property. The first is cash. In an exchange, you don't want to get any cash. It's unlike property. All right, so you don't want to get any cash. The second type of unlike property is called boot. After the word boot, I want you to write any non-cash asset. Any non-cash asset. Give me an example of boot. Non-cash would be a horse, diamonds, a boat. You cannot receive any non-cash asset. Could you give boot? Yeah, could I say, I'll trade you my building for your building and I'll give you a boat to boot? That's where it comes from. I can give boot, I just can't receive any boot. Because the only thing I can receive to have a totally tax, people say they get kind of serious about this, a tax-free exchange. Is it tax-free or tax-deferred? Well, the exchange itself is tax-free and the gain is deferred. It's deferred to the next property. When will it be taxed? When the next property is sold. But that next property, you can do a tax-free exchange and defer the gain to property C. And so on and so on. So in order to do this, it's got to be like-kind. No cash, no boot. You can't receive any of that. And then number 3, the third one, this is the one that goofs up more exchanges than anything. Next to number 3 in the left margin, draw a skull and crossbones. This is called net loan relief. And net loan relief is when you owe less. Put the word less. When you owe less money, when you owe less after the exchange than you did before the exchange. You cannot be relieved of debt. Debt relief is unlike property and is taxed. So your friend Scott, in our example, remember his properties were $310,000, $310,000 now, and he's paid the loan down to $95,000. In order for him to do a completely tax-free exchange, he would have to owe at least how much on property B? At least he'd have to owe $95,000. He has to owe $95,000 or more. Well, would he do that? Yeah, because remember, he's going to put $185,000 cash and then he's going to borrow the rest. So he'll owe way more than $95,000. So you cannot get any cash you cannot get any boot, and you cannot get any net loan relief. You with me? Now, when I say you cannot do it to get a completely tax-free exchange. If you get a little bit of cash or a little bit of boot or a little bit of net loan relief, you pay a little bit of tax. You only pay tax on what you on the unlike property you receive. All right, so you think, all right, you're explaining this to Scott, and Scott is thinking, okay, all right, I've heard about this exchange thing. I've heard about this exchange. A car would be unlike property, Brenda. Yeah, you're right. That would be boot. A car would be boot. All right. So what if Scott says, okay, I want to try one of these. I want to try. Let's say I'm Scott, and you tell me about this, and I say, oh, all right, this sounds pretty cool. And I Scott, go up to person B, the owner of property B, and say, hey, the property B is up there on the hill. I come climbing up the hill, and I say to person B, I'd like to trade you my building for your building. What's the guy going to really say? What's he really going to say? Person B, he's going to say, get out of here. Get out of here. What are the odds that person B, the person who owns property B, wants my property A? Not very good. Try impossible. So he says, get out of here. And so I come walking back down into the office, into your office, and I'm leaning on your desk, and I'm looking at you going, you told me about this exchange thing, and I thought it was pretty cool, but I tried it and it doesn't work. I went to person B and they threw me out. You would say what to me? You would say, Scott, you did this in the wrong order. I never should have gone to see person B. I should have gone to see whom? Hume. And you would have said to me, Scott doesn't want your, person B doesn't want your property. He wants your money. I say, yeah. And so you say, the way to get your money is to list your property for sale. So here, sign the listing, list it for sale. I say, are you nuts? If I sell the property, you just told me I have to pay $38,800 in tax. This is just what I don't want to do. And you look at me and say two magic words, trust me. I say, okay, I trust you. And I list my property with you, a regular old listing, nothing weird, same old listing you always use. We put it out there for sale. We market it like always in the newspaper and MLS and wherever you market property. And a buyer comes along. Brenda, you're the buyer, let's say. Brenda, the buyer, comes along and she's interested in a little apartment building like I've got. She walks around, she kicks the bricks, and she makes an offer to me, a regular old purchase contract, nothing weird. We negotiate, we bifurcate just like always. And then we have a sale. I sell the property to Brenda. Does she now own my property? Yeah. But if I take her money, what have I received? Unlike property. I received cash, which is unlike property. So I don't want the cash. Well, look at C. The net sale proceeds, underlying net sale price proceeds, are placed in a qualified escrow. Put the word qualified escrow. Qualified. This qualified escrow has to be held by a neutral third party. A neutral third party. Who can hold the qualified escrow? Anybody who's not a disqualified person. And you're like, well, that really helps. No, that's true. Anybody who's not disqualified is qualified. Now, here's who's disqualified. Cannot be any relative of mine. Cannot be any employee of mine. And here's the big one. Cannot be any professional who has represented me within the last 2 years. So it cannot be my accountant. It cannot be my attorney. It cannot be my realtor. They all represent me. It could be anybody else on the face of the earth. It could be my next door neighbor. Now, the problem is my next door neighbor would disappear with the money. So typically, these are held by entities that are geared up to handle money. Banks, title companies. There are private companies called exchange facilitators or qualified intermediaries. No, a title company doesn't represent you. They just provide a service for a fee. So the title company, the question, Stacy's asking a good question. Can you use the same title company in less than 2 years? Yeah, they don't represent you, right? Your attorney represents you, your accountant represents you, your realtor represents you. The title company just provides a service for a fee, okay? So typically there are title companies. You use title companies in Nebraska, yes? Yeah, do you use title companies? Yeah, a lot of the title companies are geared. This is called a delayed exchange. A delayed, look at D, a delayed exchange, or in parentheses, Starker. I'll tell you who Starker was in a minute. But this is I don't care where you live. If you're looking for somebody to handle your delayed exchange, look up title companies and you call them up and they'll say, hello, title company. And you say, do you handle delayed exchanges? If they don't know what you're talking about, hang up. Hey, because they don't. Now, don't just slam it down, but thank you very much. But you know what? The question I get a lot, I got a phone call from a guy. This just cracks me up. This is several years ago. A guy called me up. He lived in Montana, way up in a little town in Montana, way up at the Canadian border. I can't remember, it was like Dead Fish, Montana. He called me up and he said, hey, Tom, I did it just like you said on your video series. He said, I called the title company in my town. I said, do you handle delayed exchanges? He said their answer was, almost all of our closings are delayed. No, now slam that one down. That's not what we're talking about. This is a delayed exchange. So I sell my property. Brenda, you're the buyer. So I've got property up for sale and you come along and make an offer. Now it's real important for me to put language in the agreement that says something like that the buyer understands seller's intent is to make the sale part of an exchange under section 1031 of the internal, all that. And you think, where do I get that language? You would get that language from the title company, whoever's holding qualified escrow. Just ask them for their boilerplate language and they'll say, here's the language. They'll send you the paragraph. They'll say, put this paragraph in the purchase contract if they're geared up to do this. So Brenda makes an offer to me. We negotiate. We have an agreement. I say, my intent is to make the sale. You have to have the intent to make the sale part of an exchange. Well, she doesn't care about that. She says, okay. And so we have the closing. I sell my property to Brenda. I don't get the money though. The money goes into the qualified escrow. How much money in this case? If I'm Scott, how much money would go into the qualified escrow? You just don't know, How much would go in? Chat it in. Somebody chat it in. First right answer wins. Yeah, Matt, $190,200. You have a regular closing, a regular old closing. It's just that $190,200 net, my net equity goes into the qualified escrow. I don't get it. I don't have the right to receive it. I don't touch it for a minute. It goes directly to the qualified escrow held by, in this case, let's say the title company. So now look at this. I have now sold my property to Brenda and I've got what? I've sold my property and I've got what? I've got nothing. I don't own property A and I don't have any money. The money's in the qualified escrow. And you think, uh-oh, well, I got them right where I want them. Even though I have sold the property and I have nothing, I still have an exchange going. This is a delayed or a Starker exchange. You see that word Starker there? Underline the word Starker. Sometimes these are called Starker exchanges. And the proper term would be a delayed exchange under section 1031 of the Internal Revenue Code. People just call them Starkers. And the reason is Starker is the guy who invented delayed exchanging. Let me tell you who Starker was. Starker was a guy back in the mid-70s who owned zillions of dollars of timberland in the state of Oregon. Big money. I mean, zillions of dollars. And he went to the paper company, Crown Zellerback, and he said to the paper company, would you like to buy all of my timberland? And they said, yes, are you kidding? We could turn all those trees into paper in 2 weeks. Starker said, I want this many millions of dollars, not a penny less. And Crown Zellerback said, well, okay. And Starker said, one more thing. And they said, oh yeah, what? Starker said, I don't want any money. Crown Zellerbeck said, that's even better. What Starker said is, I'll deed you all my land, all my timberland. I'll deed it all to you, Crown Zellerbeck. Don't give me any money. And then I'm going to go out and find properties that I like, and I'm going to point them out to you, and then you're going to go buy them and deed them directly to me until I use up my credit. Well, Crown Zellerbeck said, sure, we'll do that. So Starker deeded all his land to Crown Zellerbeck, didn't get any money. Then over the next 3 years, it took him 3 years, he went out and he found property and he'd say, you know, that shopping center in Seattle, buy that. And they buy it and deed it to him. And oh, that office building in Tacoma, buy that. They buy it and deed it to him. That apartment building, oh, that apartment building, buy it and deed it to him. It took him 3 years. He ended up with 7 properties. And Starker said to the IRS, that's an exchange. That's an exchange. I don't have to pay any tax. What was his rationale? What was he thinking? What's his rationale? What's his argument? What's the only thing he received? Like-kind property. He didn't get any cash. He didn't get any boot. He didn't get any net loan relief. He only received property. So he said, that's an exchange. I don't have to pay any tax. The IRS said what? The IRS, oh, no. Nice try, Starker, but that's not an exchange pay up. Starker said, no, I'm not paying. That's an exchange. If you don't like it, sue me. So they sued him. They took him to tax court, and the thing dragged on and dragged on and dragged on. And finally, the tax court found in favor of Starker. The tax court said to the IRS, that's an exchange. He doesn't have to pay any tax. Well, the IRS went crazy when they lost. They said, come on, this can't be an exchange. It took them 3 years to do it. We don't even know what year not to tax him in. And so when Congress, when the IRS lost in court, they went to a higher authority, Congress, and they said to Congress, look, if the courts are going to allow these delayed exchanges, man, we got to have some rules. We got to have some rules. And Congress said, you know what? You are right. We'll get right to work on it. This was 1978, and Congress did what they do best. Still, they formed a committee. What kind of committee? A bipartisan committee. And that committee went to work day, nights, weekends, doing the business of the American people. And those rules were ready 13 years later, 1991. And we now know exactly what those rules are. And they're simple, simple, simple. Here's what they are. I sell property A to Brenda. The money goes where? Into the qualified escrow, right? Held by a neutral third party. And even though I've sold my property to Brenda, I still have an exchange. I have a delayed exchange going, and I have to meet 2 time requirements. So look at D1 and A and B. 2 time requirements. I have 45 days from the day of sale, underlined from the day of sale. This is from the day I sell to Brenda. From the day of sale to identify a replacement property. Put identify there. What does identify mean? Yeah, it means in writing unambiguously. I can't say, oh, I want one of those properties up there in the hill. No. You got to be exact. I want lot 1, block 2 of the Maple edition, or I want 123 Maple Street. Right? You want to identify it either with a legal description or a street address. So there's no question what property I'm identifying. So in this case, I would sell to Brenda. The money goes in the qualified escrow. Within 45 days, I identify lot 1, block 2 of property B. Remember property B where it's 14%. So I have 45 days from the day of sale to identify. And then I have 180 days underlined from the day of sale to acquire the replacement property. 45 days to identify, 180 days to acquire. You have to identify in writing unambiguously. Now, if you're doing a title company, who's ever holding a qualified escrow, they'll have a boilerplate identification page for you, most likely. And if they don't, they're not really in the qualified escrow business. All right, so look at this. I sell property A to Brenda. The money goes in the qualified escrow. Does Brenda now own my property? Yep. How'd she get it? She bought it. She's out of here. She owns my property. The money, my $190,200, is in the qualified escrow. So I have 45 days to identify. So I identify property B, and I go climbing up the hill to property B. And the owner of property B sees me coming. He goes, "Not this exchange guy again. Get out of here. I told you once I don't want." No, I say, no, I learned my lesson. I understand. I'm back, but now I'm back as a what? As a buyer. I'm a regular old buyer to property B. And so I make an offer on property B. We negotiate, we bifurcate, just like always. And person B says, okay, where are you going to get the money? I said, well, I got this money in the qualified escrow, and I'm going to use that as my down payment and closing costs. Oh, okay. And so we negotiate, and we have a signed agreement, and we have to close within what? 180 days. Now it's not 45 plus 180. The 45 is part of the 180. Notice that they both say from the day of sale. So the day I sell to Brenda, that's when the deadline starts. That's when the 45-day deadline and the 180-day deadline start. All right. So we make an offer, we have a negotiation with property B. We need to close within 180 days. And here we are at the closing. And at the closing, what happens? The money comes out of the qualified escrow directly to whomever is closing the transaction, and they distribute the money accordingly. And when the dust is settled, who's got what? What's Brenda got? She's got property A, my old property A. How'd she get it? She bought it. She's happy. She's out of here. What does person B have? Person B has money. What did he want? Money. How do you know he wanted money? He's got his property up for sale. Everybody who's got their property up for sale must want money. People say to me all the time, where do you find properties to exchange into? You know, it's every property up for sale is for exchange. What do I now have? I have property B. How did I get it? I sold property A to Brenda and I bought property B. But the IRS says if you did it this way under this umbrella, delayed exchange, you don't have to pay any tax. Pack up your gain and carry it with you. You don't have to pay the $38,800 in tax. Look at the power of this. How many exchanges were there here? How many exchanges were there? None. Zero. What's my relationship with Brenda? I'm a seller, she's a buyer. What's my relationship with person B? I'm a buyer, he's a seller. There's no exchange. Do Brenda and person B ever even meet each other? No, probably not. Could my property be in Wisconsin and person B's property be in Nebraska? Sure. It's a sale and a buy. But if you do it under this umbrella, the IRS says, pack up your gain and carry it with you. You don't have to pay any tax. Now, it's 180 days from the day of sale. There's no extension. It's 180. Here, this is important. It's 180. Let me do this. It's 180 calendar days, not business days. 180 calendar days. And it's not 6 months. It's 180 days. What's the difference? 2 or 3 days, right? Depending on what 6 months you're talking about. I have a friend who's a baseball player in Arizona whose attorney told him he has 6 months to do the exchange. He closed on the 181st day, had to pay $60,000 in tax. And his attorney paid it. His Arizona emissions insurance paid it. It's not 6 months. It's 180 days. And there's no extension. What if I'm going to closing? What if I sell the property to Brenda? I make an agreement with property B, and then I'm going to closing with property B on the 180th day. And I drive to the closing, I park in the parking lot of the closing company, and I'm walking across the parking lot and I get hit by a truck. I better drag myself in there and have somebody move my hand and sign those papers. Or I better hope the truck killed me and the gain is forgiven, because there's no extension. No extension. Yeah, now it's the closing. You don't have it's not a sale till you close. Steve, that's it. It's not when I sign the contract with person B, it's when we close. Right? How many of you ever had a closing not happen on a contract that was signed? Yeah, so it's not a deal till it's closed. Now, what questions? What comes to mind? I can think of a big one. What do people always ask right now? I've identified property B, let's say. Yeah, there you go, Steve. Yeah, that's it. What if I identify property B and for some reason I cannot buy property B? Right? What if person B decides not to sell, or somebody makes a higher offer and buys property B? So if I can't buy property, if I cannot acquire the property I identified, then the money comes out of the qualified escrow and I'd have to pay the $38,800. So the question that you're asking really is, can you identify more than one property? Can you identify more than one property? The answer is yes. Look at E. I'm still on page 9. Look at E. It says, can you identify more than one property? Then it has a blank and a comma and a blank. In the first blank, I want you to write yes. Then after the comma, I want you to draw a great big but. Or don't draw a big but. I mean, write the word but, 1 T. Yes, but you cannot just identify the Lincoln, Nebraska phone book. There are limits to what you can identify. Now, do you remember I told you it took them 13 years to write these rules? Here's what 12 of the years took. All right, so can you identify more than one property? Yes. And should you identify more than one property? Yes, in case you cannot close with person B. You got to have a fallback. All right, so number 1, you can identify 3 properties of any value. So put 3 properties of any value. So could I identify property B, property C, and property D? Yeah, and close on which? Any 1, 2, or 3, whichever ones. So I can identify up to 3 properties of any value. Or, now there's an or between these. Or you can identify any number of properties as long as their combined value is not greater than 200%. Put 200%. All right, of the sale price of your old property. So you can identify any number of properties as long as their combined value is not greater than 200% of the sale price of my old property. Remember my old property, property A, I sold to Brenda for $310,000. 200% of that would be $620,000. So I could identify any number of properties I want as long as they don't add up to more than 620,000, more than 200% of the 310. So look at this. The first one limits how many. The second one limits what's the value. Or, remember there's an or. Number 3, you can identify any number of or value of properties as long as you actually acquire 95% of the combined value of the properties identified. All right, so could I in theory, could I identify the Lincoln, Nebraska phone book? Yeah, but I'd have to what? By 95% of Lincoln, Nebraska. So I couldn't do that. So that's no good. Or number 4, you can identify any number and value of properties as long as you acquire them within the blank day deadline. What goes in that blank? Nope, not 180, within the 45-day deadline. So the last one put 45-day deadline. Okay, I should have been filling this in, shouldn't I? There you go. So yes, but you can identify 3 properties, or you can identify any number as long as they don't add up to more than 200%, or any number in value as long as you buy 95%, or lastly, any number in value as long as you acquire them within 45 days. They bump the deadline up. What they're saying is within the first 45 days, you can do whatever you want if you can get it closed. Which of these do you think is the most commonly used? Number one, 3 properties of any value. As a matter of fact, I think most people think that's their only choice, but that's not true. That's not true. So should I definitely identify the 3 properties? Yeah, even though property B is the one I really want, I'll identify some backup property. Mike, can you make the sale of A, can you the closing of B as long as it's after the closing of A? Yes, make sure you're dealing with an accountant and attorney who really understands. Mike, call me separately and we can talk about some of that. I don't want to get too deep into the weeds here, but I'm happy to talk about it with you. You want to absolutely deal with an accountant and an attorney who understands this, and this is a specialty. How many of you ever gone to an accountant and you say, I want to do an exchange, and they say, oh, it's too complicated. It's so complicated. I've never seen one happen. Well, that's not true. This isn't complicated, is it? It's not complicated. Break it all down. Just boil it all down. What do we have here? We have a sale and we have a buy. That's it. We're doing it under this umbrella, and the IRS says, well, okay, we're not going to treat it as a sale. We'll treat it as an exchange because you are merely continuing your investment. When should you do this? When would you do this? You would do this as soon as you could do better in property B than you could do in property A. How do you know when that is? Well, every year you're going to use the investment property worksheet to calculate your rate of return on your equity. So here, let's go back to Scott. Here's our pal Scott. Property A, he's got $190,200 equity in property A. All right. If he keeps property A, he'll earn 4.8% in the next year. You find property B for him. Property B needs 185,000 cash to purchase, but it'll produce a 14% return. So you say to Scott, come on, hubba hubba, let's move your equity from property A to property B. Well, if you do that by selling property A, you've got to pay 38,000. He has to pay $38,800 in tax. So you say, let's do an exchange. And Scott says, no, my accountant said this is so complicated, it'll kill me. You say, nah, trust me, it's a sale and a buy. So Scott sells the property to Brenda, the money goes in the qualified escrow, and then he makes a deal with Scott, with property B, and closes within the 180 days. Now, the question is, this only works if he didn't have to pay tax. Isn't that true? Now, would it be a wise thing for him to do this? Well, yeah. Why? Based on what? Forget rate of return. Forget a rate. Based on money. So I want to show you a neat little worksheet. Look in the back of your book and look at a return on equity worksheet. Look at a return on equity worksheet. Take one of those. Grab one of those. Return on equity worksheet. That's not it. Here's another neat little worksheet that I've got for you. And so I want you to look at this. Tear it out of your book so you've got it right by your side. And look what this says. Here's a return. We're going to compare your current property. So there's two columns here. Your property, your is Scott in this case, and the replacement property. All right, so fill this in with me now. The current, if I'm Scott, the current fair market value after selling expenses is 285,000, right? After selling expenses, 285,000, and I've got to pay off my loan of 95,000. So subtract that. Do you see where the net equity is? $190,200, right? That's the number we've been dealing with. All right, the replacement property, property B, requires 185,000. So put 185,000 would be the net equity we'd ultimately have in property B. All right, then would you do me a favor and complete the rest of the worksheet? Complete both columns. Property A, if I keep this property, what's my annual benefit going to be? My coming year benefit. And then what's my rate of return down at the bottom? Do column A all the way. Then do column B all the way. And then you've got something to really compare. You asked me earlier, how do you compare this? Here it is with money. What people care about is money. I don't want to know rate. I don't want percentages. I don't understand percentages. It sounds like earned run average. I couldn't figure that out either. Go ahead and try it. Now you could put $190,200 down cash invested into the replacement property. I'll show you that in a second. So Matt, hang on. But for right now, compare these two. Go ahead and do it. I'm going to be quiet. You go ahead and do it. Tell me my total, my rate of return and the amount of money I'd have if I keep property A versus acquiring property B. You've got all the numbers in what we've done here so far. Go ahead and do it. You can do it. Chat in your answers. I'm gonna let you try it. Chat in your answers. Matt, you're absolutely right, but I'll show you how we're going to handle that. Do column A first, then, or not column A, do your property first and then replacement property next. And again, think how you would explain this to people. What'd you get for total annual benefits? Chat in your answer now, so I can, and the rate of return. For your property, you've already done all the work, so you're just putting that information in. Think how you would explain it to people. I want you to explain this to me. Yeah, that's it, April. Sarah, good. Keep going now. Stay in that first column and now do it by percentage. That's it, Brenda. That's your annual benefits, right? So now finish column A, or your property, first column, to give me the percentage. Yep, Stacy, there you go. So all those numbers, that's what we've already done the work. So this is just a summary. Yep. Yep. Good. Do Roman numeral 2 to get a dollar comparison. Roman numeral 3 is a percentage comparison. Good. There's your percentages, Brenda, Sarah. Good. Now do the same thing over for the replacement property. Dan, I'm not sure. Let's see, what is that? Not sure what that number is, Dan. If you're doing the first column, just take the information from the worksheet you already done, the worksheet you did right after lunch. The return on equity worksheet. There you go, April. And so that's your dollar comparison. Now do the rate of return comparison, Mike. That's it. And there it is. There it is in black and white. You can't argue with it. That's it, April. So in Roman numeral 2, you're comparing the dollar differences. In Roman numeral 3, you're comparing the rate of return differences. So whatever's most important. Remember you were asking earlier, was it Mike? Mike, you were asking me, what are most people concerned with? I don't know. Everybody, here it is. If you're concerned with dollars, here it is. If you're concerned with percentages, here it is. Check your answers against mine up on the screen. Wouldn't it be this? Right? Isn't these are the dollars? These are what we just figured out. So can you see my cursor? Yeah, it shows up. So here I am, Scott, in property A. I've got 190,200 net equity. And then if I keep the property, I'll get 5,600 cash flow. You figured that earlier. I'll get 2747 principal reduction. I'll save $796 in tax. My total benefit then would be 9143. What do I have invested to get 9143? Well, down at the bottom, you merely take your 9143 and divide by your net equity. That gives me 4.8%. That's what we got earlier. 4.8. If I keep the property, I'm going to earn 4.8% of my $190,000. What if I take 185,000 of that and buy property B by doing a what? 1031 exchange, a delayed exchange. I sell and buy, but I do it under the delayed exchange rules. Then I'm just continuing. Well, if I do that, and I can do it if I don't have to pay tax, I'd end up with 17,500 cash flow, 6,000 principal reduction, 2,400 tax savings, 25,900 in benefits. Look at this. All I'm doing is moving my net equity from this property to this property. I'm going from 9,000 to 25,000, almost 26,000. That's the dollar difference. If somebody likes rates of return, I'd be going from a 4.8% return to a 14% return. Look at the power of this. If you show this to people, there is no way somebody can look at this and say, I'm keeping property A. If they're looking at it with their head. If they're looking at it with their heart, they're going to say, I love property A. It's the first property I ever bought. I'm keeping it. Well, okay. But knowing what it's costing you, look at what it's costing you in percentages down here. Look what it's costing you in dollars up here. Come on, hubba hubba. And so look at the 8-step process. Look at step number 6. Compare the two properties using the return on equity worksheet. That's what we just did. We compared the two properties, compared the two choices. And then step number 7 is use the exchange worksheet to see if property B can be acquired without paying tax. I'm going to show you a really neat little worksheet. And we'll go through that, but I don't want to start it because we'll have to take a break in the middle. So let's take a break right now. Take a break. Let's do a 15-minute break. So this is our last break, 15-minute break. So chat in your your questions, get away, go do some more jumping jacks. I think I'm going to go roll down the hill into the leaves. I'll be back.
Are you going to be dressed when you do that?
Yeah, I hope so. All right.
Bye.
All right. All right. Get out of here now, everybody. 2-minute warning, everybody, 2 minutes and we'll go to work. All right, everybody, let's go back to work and see if we can help our friend Scott here increase his return on equity from 4.8% to 14% and increase his annual benefits from 9,000 to 25,000. I think you'd find interest on the part of Scott if you could explain this to him. So will that happen? Can that happen? Yeah, it can happen. Absolutely. He can do this. He can sell property A and acquire property B with by doing an exchange without paying the tax. Now, the question is it really true that he doesn't have to pay tax? Well, it's true as long as he only receives what kind of property? Like kind property. He doesn't want to receive any unlike property. So we need to analyze the exchange. Wouldn't it be cool if there was like a one-page worksheet that allowed us to analyze an exchange? And you say, well, yeah, well, it's a miracle. Look at the last page in your book or toward the last page, and there are several exchange worksheets. Tear out one of those exchange worksheets. And so in our 8-step process, what do we got here? I'm going to put it up here. In our 8-step process, we've done step 1, 2, 3, 4, 5, 6. We've compared the two properties using the return on equity worksheet. And now step 7, we use the exchange worksheet to see if property B can be acquired by Scott without paying tax. And this is a neat little worksheet to analyze an exchange before you do it. So look at this. Let's fill this in together now. There are 6 Roman numerals we're going to fill in. And the first thing we do in an exchange is to inventory the property. Who has what? Well, person A is Scott, person B is person B. And so let's see what Scott has. Let's fill it in. He's got a property valued at $310,000. So fill this in with me now. He owes $95,000 against it. He has gross equity, $215,000. All you ever have to exchange is your equity. So he's got gross equity, $215,000. What does person B have? Remember, person B, or property B, is $540,000, right? And let's say we don't know anything about person B at this point. We don't really care at this point. Let's assume person B owns the property free and clear. So person B has $540,000 equity. All you ever have to really exchange is your equity. So now look at this. If Scott went to person B and said, hey, I'll trade you my building for your building, even if person B wanted Scott's building, What's Scott asking him to do? He said, I'll give you 215,000 if you give me 540,000. Well, that's not going to work. And so whenever you have uneven equities, which is always, number two is you have to describe how the equities will be balanced. Well, Scott owes a big pile of money to property B. Scott owes 325,000 to be obtained by a new mortgage. Scott has to balance the equities. So his 215,000 plus 325,000 by a new mortgage would give the 540 to property B. Okay, so he always balance the equities. How's he going to get 325,000? He's going to get a new mortgage. How's he going to get a new mortgage? How much does he need to get a new mortgage? He needs 185,000. Remember, 175,000 down plus 10,000 closing costs. All right, so let's say that happens and we do the 45 days and the 180 days, just how we've been doing. And let's complete the worksheet for person A. That's Scott. Now, I've got two columns here. On the off chance you're ever going to see a 1-for-1 exchange where they each want an exchange, you're never going to see it. I defy you to show me one that makes sense. I've never seen one. All right. So under 3, let's calculate Scott's, because we're going to analyze the exchange from Scott's perspective. He's the only guy who cares about the exchange. Well, we take the fair market value of the like-kind property given. That's 310,000. So put the 310 there. All right. Minus the disposition costs, which are $24,800. Now, why doesn't it say sales cost? Because it's not a sale, right? We're not selling. We're disposing of the property. We're exchanging. So the 310 minus the disposition cost minus his basis of the like-kind property given. Remember, his basis was $130,000. The same number we got before, 130,000. So if you do that math, you get a realized gain of $155,200. Remember, that's exactly the same that you already figured in step 3. You figured he's got $155,200 gain. Now, here's a question. Does an exchange change your gain? Nope, it does not change your gain. You've got $155,000 realized gain. The question, how much of that gain is recognized? What does recognized mean? Recognized means taxed. How much do we want to have recognized? 0. 0. Can you have 0 recognized? Yes, as long as the only thing you receive is what kind of property? Like-kind property. You don't want to get any unlike property. What are the 3 types of unlike property? Cash, boot, and net loan relief. Look at Roman numeral 4. How much cash does Scott receive in this transaction? None. None. Now, here's where we got to make a little bit of an assumption. Scott, remember, has $190,200 in his qualified escrow. And property B only requires $185,000 down payment and closing costs. So if Scott only puts $185,000 into property B, then he'd have to pay tax on the difference between the $185,000 and the $190,200. So Scott doesn't want to do that. So what's he going to do? He's going to put the whole $190,200 down on the property and get a little bit smaller mortgage. That'll increase his cash flow and so on. All right. So now if he did take the 5,200, he'd pay tax on 5,200 and the rest of his gain would carry over. So he doesn't get any cash. How much boot does he receive? Nothing. He's not getting any boot. How much net loan relief does he have? None. He's going from $95,000 loan to a $300,000 loan, whatever it is. How much cash is he giving? This is cash he's bringing from outside the transaction. Well, he's not bringing anything. So the total unlike property is 0. 0 plus 0 plus 0 plus 0 equals 0. So the recognized gain, here's a really important line up here. The recognized gain is the lesser of line G, which is 155.2, or line L, which is 0. The lesser of those two is 0. He has 0 recognized gain. What does that mean? I don't know what you're talking about, recognized gain. What does that mean? 0 recognized gain means no tax. Oh, I understand that. I understand that. The gain is still 155.2, but the IRS isn't going to recognize any of it. They're not going to tax any of it. Why? Because he only received like-kind property. So he gets to pack up that $155,200 gain into a little suitcase figuratively and carry it with him to property B. And it'll sit in the attic of property B for as long as he owns property B. Now, how do they know how much he's got in his suitcase? How big a gain? Well, look at number 5. We calculate the unrecognized gain. How much of his gain was unrecognized? You take the realized gain, 155.2, less the recognized gain, which is 0. So 155.2 is the unrecognized gain. His entire unrecognized gain is 155.2. His entire realized gain is unrecognized, meaning not taxed. So he packs that 155.2 into a suitcase, carries it with him, and it'll sit in the attic of property B for as long as he owns that property. He doesn't pay any tax. Now, how does the IRS know that that 155,200 is sitting in the attic of property B? Well, we have to do a little bit of an adjustment with his basis. Look at Roman numeral 6. Here's his new basis after the exchange. You start with the fair market value of the like-kind property received. What did he receive? 540,000. All right, then you have to subtract the unrecognized gain, subtract the suitcase. You get to add in any acquisition costs, which in this case were $10,000. That's his closing costs. So if you do that math, his new basis after the exchange is $394,800. All right, now that's a lot of numbers, I know, but so look at this. What does it mean? Here's what it means. Bottom line, here's what it means. Look at this. Scott went from a $310,000 property to a $540,000 property. He went from a $155,200 gain. He exchanged into a $540,000 property. He didn't have to pay any tax. He went from a $130,000 basis to a $394,000 basis. That $394,800, what does he do? He divides that into land, building, personal property, and land improvement. He rebifurcates. So he's got, look at 1.5 times the real estate. He's got 3 times the basis. He's going to earn, instead of 9,000 over the next year, he's going to earn 25,000 in net benefits, and he paid no tax. Is this legal? Yeah, it's legal. It's legal. Now, I know there's a lot of numbers flying around. I understand that, but just promise yourself, those of you who are interested in this and can see a use for this, you can build an entire real estate practice around this, and you'll have no competition, literally none. As a matter of fact, you'll get referrals from other realtors because it gives them a headache. And there's no hard math. There's a lot of numbers. If you have questions, I'm glad to help you with this, if I can help you with this. All right. So the 8-step process, we've done the worksheet, and then look at step 8. Calculate his relative wealth in 15 years. So here's our pal Scott. If he keeps, he's a young guy. You met him at your 20th reunion. What if he keeps this property for 15 years? What his old property? What if he just said, "Hey, thanks for coming. Nice to meet you. I'll see you at the 40th reunion." Could you say, "Wait, Scott, let me just show you one more thing." If he keeps the property, he's taking that $190,200. He's investing it at 4.8. The value in 15 years is $384,000. Not bad. It's not bad. That's if you can maintain the 4.8. What's really going to happen? It's going to get weaker, weaker, weaker. But what if you could show him how to do the exchange and earn the 14% over the next 15 years? Now, what's he going to have to do probably over the next 15 years? He might have to exchange again. He might have to exchange every 5-year reunion you have. How's he ever going to know when's the time to exchange? You're going to show him every year. You're going to figure the return on investment on his equity. If you can maintain the 14%, you know what that grows to?